Every week that passes, the expectation about how much the Fed's going to cut rates gets less.
It's going to take more time for cuts than people would like.
We have a Fed that we've had some walk back of if March is on the table or not, but I think the base case is still their next steps are easing.
We're in the same camp as the Federal Reserve. We need to see more data.
We look at rates and where the Fed is today. The Fed has gotten us to where we need it to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Brace yourself. Bramo hot take on the president's news conference yesterday evening, coming right up. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.1% on the S&P. Was the market even open yesterday? The trading range was so tight. At a close on Wednesday within 5 points of 5K, on Thursday within 3. We hit that milestone for about a second, Bramo, and then we backed away from it.
It basically was pushed over there just begrudgingly by a market that really doesn't want to really have any direction, because why would you right now? People are worried about momentum given the fact that we've seen this incredible rally, and yet high valuations, questions about Fed rate cuts and just how many can happen, and concerns about profitability and whether expectations are too high, all plaguing the market.
On course for 5 consecutive weeks of gains on the S&P 500. With all that in mind, look at the bond market. Yields higher on the week. 2-year, 10-year. The bulk of that came on Monday, though. Then we've got to pass through the data. Then we can talk about the auctions. The data, it was Monday. It was a really, really solid ISM services read. Jobless claims yesterday, the right kind of downside surprise. 8:30 Eastern time. Don't usually do this. We're going to be talking about inflation revisions. They were important last time around. They're more important now. Governor Waller last month, this was the quote. "My hope is that revisions confirm the progress we have seen, but good policy is based on data and not on hope."
Happy annual revisions to seasonal adjustments for monthly CPI day. That was basically what I came in thinking. We're really going to care about this. Well, Chris Waller cares, so we care. And basically, if it changes to the upside like it did the last time around, does that materially change the view? I've read note after note basically saying this could be a big deal, but it won't be. And just wait for next week's CPI report.
Priya Misra, JP Morgan Asset Management, said it's important. Ellen Zettner of Morgan Stanley said it's important. So important, this Fed can't commit to easing until they really get their hands around the trend. I think you saw that from Chairman Powell in the news conference last week. Wasn't comfortable enough yet to suggest that maybe this was all said and done, maybe still concerned about one-off factors bringing down inflation, and worried still about the prospect of inflation stabilizing above target.
What I've heard from every investor, though, who's come on, frankly, is that nobody is pricing out rate cuts this year. They still are pricing in 3, 4, 5 even rate cuts later this year as there is some weakening. So here's a question. What will it take for the market to wake up to the view and the projection that the Fed has put out there, other than just say the Fed is wrong and we're right? Because that's essentially what the market is doing, despite the pushback and, frankly, despite some of the better than expected data.
Let's talk about this bond market. So yields up this morning by a single basis point, 10-year 416.57. We had a 10-year auction earlier this week, 42 billion. Really decent. 30-year auction, 25 billion yesterday. Went pretty well as well.
All of them going pretty well, despite this concern about the budget, despite the fact that interest payments will outstrip some of the military spending in the United States this year. All of this doesn't seem to be playing into the bond market. Why? Well, person after person has come on and said, bonds are back. We could get some income. We have a guest coming up who's going to say there's something for everyone. Pick your poison. You've got it. You've got income. And so people are trying to lock it in at a time where there's some real concerns about long-term inflation and the deficit.
I'm sitting here smiling. We're 3 minutes into the program. I cannot believe we still haven't talked about it.
Okay. I know, I'm waiting for you to get to it.
Here we go.
Okay.
If you are running to be the president of the United States, do you want to be described as a well-meaning elderly man with a poor memory?
Do you want to not be tried for something because it would be difficult to convince a jury that they should convict you of a serious felony that requires a mental state of willfulness? Oof. Do you really want to have that? Look, take a step back. There are a lot of questions about this. President Biden responded by saying, I am not a man who has problems with my memory. And the Mexican president, Sisi, of Egypt, is, and that was a problem. Here's the issue. On Wall Street, executive leadership is defined by creating a cadre of people of succession where you can pass the business down. You have a sense of who comes next. The executives in charge of this country have not done that. And that, I think, is a real problem and a liability. And frankly, in betting markets, people are starting to question whether Biden will really be the nominee.
So well said, and what a 24 hours it's been for US politics. The compare and contrast is amazing. Waking up this morning, the front pages, every single political note, every newsletter I'm receiving this morning is about Biden's memory. Nobody is talking about the fact that we had a Supreme Court hearing yesterday about whether the former president could even run in the election this year, which is kind of amazing. If you thought that was going to be a bad day for the former president, think again. I would say yesterday was a phenomenal day for the former president. It's the sitting president that's getting all the bad headlines this morning.
Even though we're actually talking about states not wanting to put the former President Trump on the ballot, what I find interesting, though, the Supreme Court actually crossed partisan lines. So normally they're the cadres of liberal and more conservative justices. And the majority of them, including some that are more considered liberal, said, you know what, this is a federal issue and he should be on the ballot. And this is not something that states can decide state by state. So that at least was less politicized in terms of trying to create a democratic grounding. That said, the fact that we're not talking about that and that we're talking about memory issues, to your point, well said. It's a problem for Biden.
Stay tuned for more of this throughout this morning. Let's kick it off with a price action. Equity futures on the S&P 500 positive here by 0.06%. There's a lift. Yields are higher by a single basis point, 416.57. The euro just a touch weaker against the dollar. Euro dollar 107.64. Coming up this hour, Jonathan Stubbs of Berenberg with the S&P 500 hitting yet another all-time high. Jeanette Lowe of Strategas as President Biden confronts more questions about his memory, and Bloomberg's Deborah Akin as Hermes defies fears of a luxury slowdown. Now, Lisa, I'm trying to work out Hermes story or luxury sector story. Feels like the former and not the latter.
It's because you have an incredible bifurcation in luxury. And that I think you can see with the fact that Hermes is planning 8 to 9% price hikes on their items at a time where you're seeing L'Oreal and Estee Lauder, you're seeing Kering or the Gucci parent company struggle. So it's sort of the haves and the have-nots. Who caters to the highest end of high-end luxury? You're doing great. Everybody else, and that sort of seems to be the theme.
I get the feeling this is not the buy now, pay later crowd buying those Birkin bags, right?
Well, did you see the Affirm? They actually came in lighter than expected. So I wonder if some of those people are pulling back, exactly to your point. Maybe this isn't the entry-level type of luxury.
Not at all. Deborah Akin with, I think, quote of the morning on this company, and we'll speak to her in about 25 minutes. High luxury league of its own. That stock is up by about 4.5%. We begin with our top story. The US stock market rally continues. The S&P 500 hitting 5,000 intraday, closing just shy of the milestone. Jonathan Stubbs of Berenberg with a warning, writing this. The broad US tech group presents valuation headwinds. Absolute multiples have expanded significantly, and the relative PE for US tech versus global equities gives a sell signal. Jonathan Stubbs joins us now for more. John, let's get straight into it. It gives a sell signal. Does that actually mean you want to sell?
In markets, in life, things are often more complicated. We have valuation signals which we have to respect, which tell us to sell US tech at this point. That's pretty clear. We also have sort of momentum signals from price and earnings, which will tell you the opposite. So I think investors are caught between the two schools. And for the moment, momentum's winning. We run strategies which try and capture both of them. And we end up at a bottom-up level with some exposure to tech, but also with broader exposure to other parts of the market as well. We think that's a more sensible path to take.
NVIDIA earnings come out in about 2 Wednesdays' time. I think we're all asking the same question, John, whether the earnings power of the Magnificent 7, 6, 5, 4, pick your number, can continue to power this rally stateside.
Well, if you break the 500 into the Mag 7 and the SPX 493, the Mag 7's outperformed the 493 in earnings terms by around 90% since Feb.
We seem to be getting some sort of technical.
We've lost him there, have we? I'm not sure what happened with that
He just turned it off. He just said, "I'm done. I'm sick of talking about the Mag 4, Mag 3."
Jonathan Stubbs of Berenberg with a connection issue. We'll try and re-establish that. Do you know where he's looking? Elsewhere. Jay Poloski doing the same thing. Europe, international equities. And the question I wanted to ask John in just a moment was about European banks.
Yeah.
How constructive is he on the European lenders? Can you really look to Europe and what you're buying? And I remember what you said a few weeks ago. When you're buying Europe, what are you buying? Skinniness? Weight loss drugs, right?
You're buying,
luxury goods and financials.
Skinniness and luxury. I mean, essential and financials. Maybe is that what people want? I mean, Jay Pulaski can come on and talk about why that's a great trade. This has been the Widowmaker, and we've seen this continually. Although I do wonder if there's a new focus on efficiency and maybe higher rates. Again, though, people have been betting on that for so long. The fact that they're being forced into trades that they have previously left out to dry shows you that people are feeling a a bit risk on.
Let's turn to the price action. Equity futures on the S&P 500 just about positive by 0.1% on the S&P. There's a little bit of a lift this morning after closing just short of 5K at the close yesterday. The bond market yields just a little bit higher by a single basis point, 416.57 in the FX market. The euro 107.66. We're negative on that currency pair by about 0.1%. Lots of pushback to the old rate cut call throughout the week from Fed speakers. Barkin with us yesterday talking about nobody wants inflation to re-emerge. President Kashkari early on in the week said need a few more months least of inflation data before easing policy. Collins admitting that rate cuts were likely this year. And then we heard from Governor Kugler. Haven't heard much from her so far in her term on the FOMC, indicating little urgency to reduce borrowing costs. That seems to be the consensus at the moment.
Yeah, I think that was her first public speech since she was appointed, since she was confirmed in September. The point that I'm looking at, though, in markets is you're still pricing in about a 20% chance of a March rate cut. Why? Is this real estate worries? Is this belief that we have more weakness out there? You've heard basically the Fed all but tell us that they're not going to cut rates in March, and yet we still have a 1 in 5 chance of getting that in March. Again, this just speaks to a sense that people are expecting the Fed to sort of tilt to the dovish going forward, and that is the bias right now in markets. Does it come through? That is what I find really interesting.
A bit more Fed speak coming up a little bit later before the weekend and before CPI next week. I understand we can't re-establish that connection with Jonathan Stubbs of Berenberg, so if we quit trying, I think we've quit trying. John, we'll speak to you in a few weeks' time, I'm sure. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Supreme Court appears ready to keep Donald Trump on this year's presidential ballot. Justices cast doubt over Colorado voter efforts to disqualify him over his role in the January 6th insurrection. Both liberal and conservative justices question whether the Colorado State Supreme Court had power to exclude Trump on the grounds of the 14th Amendment. The court is set to reach a ruling on an expedited basis, which means it could come in the next several weeks. Treasury Secretary Janet Yellen says regulators are watching for risks stemming from non-bank mortgage lenders. She was speaking at the Capitol and cautioned that non-bank lenders risk failing due to their lack of access to the same deposits as traditional banks. Non-banks have become a major presence in the mortgage market, and regulators have continued to warn that oversight hasn't kept pace with their growing footprint across finance. The panel that blew off a Boeing jet during last month's Alaska Air flight showed signs it had moved prior to the accident. That's according to Senator Maria Cantwell, who was briefed on the situation by NTSB. Investigators found marks on the panel indicating it had shifted prior to breaking loose on January 5th. In a statement, Alaska Airlines said there was, quote, no indication of issues with the door plug prior to that flight. That's your Bloomberg Brief. John.
Hey, Danny, thanks for that. Just getting some earnings from PepsiCo. Let's look at the stock right now. It's down about 1.8%, Lisa. Your read on these numbers?
Just taking a look, it looks like snacks. People are buying more Frito-Lay chips, Mountain Dew, Gatorade. You'll be happy to know. They're looking at an earnings per share growth for the year, at least 8% on an adjusted basis, organic revenue 4%. Basically, this is within range. But again, within range is not good enough. As people look out, what you're seeing right now is consumer behaviors largely reverting to pre-pandemic norms. Key question, what about Ozempic? And so we'll dive into that later.
I imagine that a lot of people on the call are going to dive into that later as well. The stock is lower by 1.8%. The broader equity market positive by 0.1% on the S&P. Up next on the programme, President Biden on the defensive.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine.
That conversation is coming up next, live from New York City. This is Bloomberg. Live from New York City this morning. Good morning. Welcome to the program. Equity futures on the S&P 500 just about positive again by 0.1% on the S&P over the last 3 days. I think 3 days of gains on the S&P 500, just grinding out day after day. An okay day of gains. Yields up by a single basis point. The 10-year 416.37. Under surveillance this morning, President Biden on the defensive.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine. The president of Mexico, Sisi, did not want to open up the gate to allow humanitarian material to get in.
That was awkward. Here's the latest. A heated exchange at the White House with President Biden angrily defending his memory after a special counsel report on his possession of classified documents described him as, quote, a sympathetic, well-meaning, elderly man with a poor memory. Shortly after, Biden mixing up the names of world leaders once again, referring to Egypt's President al-Sisi as the President of Mexico. Jeanette Lowe, Director of Policy Research at Strategas, joins us now. Jeanette, I know it's frustrated. You want to focus on policy. We do too. But this is the focus at the moment. What are you telling clients about it, particularly when people are still asking whether this is going to be the nominee for this election this year?
Well, good morning. I think, voters in particular have concerns about both of the current front runners for the nomination, so both Biden and former President Trump. And so that's something that it continues to be a concern as to whether or not there could be an opportunity for either of those two individuals to not be at the top of the ticket as we get towards November later this year. So I think that there is something that we do have to kind of always keep an eye out for, and that is that there could be a change potentially at the convention for either one of the parties. It's a very low probability, but it's not something that we're going to discount, that we do have to still kind of keep in mind and have that opportunity out there that there could be someone else who gets changed, either because of a health event or because of a criminal event or something like that. So it's something that we do have to keep in mind as we move forward into the election.
Jeanette, even if they are the nominees, can you just tell us whether ultimately you think this is going to be a traditional campaign? And by traditional campaign, I mean debates, people on the road all the time talking, or based on the latest gaffes, whether they're going to have to pull him back once again?
Right. I mean, I think you're probably still already in an extraordinary election because you have a president who you have, first of all, former President Trump, who is running, who has a number of charges filed against him. You have this also a unique situation where you have the current president and you have a former president running against each other. You have a lot of concerns with Biden, whether he would actually be on the campaign trail. So I do think this is going to be quite a unique campaign cycle that we're looking forward to. And it might be very different. We do probably expect that there should be debates ultimately, but I think that things might be different down the stretch as to how much campaigning is getting done. You do see the Biden administration trying to get on the road a little bit more, but I think there'll also be some reliance on the vice president to do a lot of that for the president. So I think it is going to be quite unique, and we'll have to kind of take things a little bit differently than we normally would have, just given the unique circumstances this cycle.
Jeanette, we've talked a lot about how important it is to know who the president is going to be, to understand what the policy is going to be, whether it's antitrust issues having to do with mergers and acquisitions, whether it's tax issues having to do with sanctions on China and other nations. How frustrated are some of your clients, and how much are they paying attention to this to try to get any information on that front versus just the noise that we seem to be getting every day?
Well, and to some extent, what is actually helpful in this cycle is that we actually do know Trump and Biden rather well in the sense of what their policies are. So the difference this cycle is that you're not having someone new come in where investors have to think about what could be on their agenda. We have at least some baseline of where both of these candidates are on various issues. The problem, as we just kind of spoke about, is that there's so many other factors that might be coming into play this year, especially with, criminal trials going on, these classified documents cases. All of this adds some additional uncertainty that takes place that makes it a little bit harder to kind of frame out how the election may play out, and then what issues are going to be on the top of the agenda for whoever becomes president in 2025.
When you talk about, we know the candidates quite well, do we? Our next guest, or one of our guests coming up later in the show, wrote this in his notes. Rumor going around D.C. is Biden is staying in the 2024 race long enough to win the nomination, then pass the buck to another Democrat, TBD Michelle Obama. Do you buy into any of this, that there's basically going to be just sort of a quick switch at the end, and we aren't going to necessarily have a clear sense of who that nominee is going to be?
So I think Biden has actually been pretty clear about this. He is in the race because Trump is in the race. Now, if Trump were not to be in the race, perhaps there might be some movement to change at the convention. But again, that's a very low probability. And then you have to figure out who's going to be next in line. I mean, obviously, I think people would think that it should go to Vice President Harris. And if you were to try to put someone else in there over her, there would be a civil war within the Democratic Party. And that's not really something that you want ahead of the general election. So I think that that's that's quite unlikely. I think that he's been clear that he is running because he thinks that he is the candidate who can beat Trump. And I also think that Michelle Obama is probably not quite interested in getting back into politics at this moment.
Let's talk about policy. Less on politics if we can. There are some bills potentially going through Congress. Let's talk about the bipartisan tax bill, one, and how likely is it that we'll pass an aid bill without anything on border security anytime soon?
Yeah, so the Senate is now moving on to this national security bill. This is a $95 billion bill. They're going to work through the weekend, maybe even to next week, to try to get this done. Now, it does have some hurdles, even if it gets past the Senate, as to whether or not it's going to move forward in the House. But this is something that is quite important to a number of members of Congress. They do want to provide one more aid package to Ukraine ahead of the presidential election. There's also this tax bill that you just mentioned that's also going through. This passed the House on a very strong bipartisan basis. There are a lot of members in the Senate who also want to pass it despite the call for changes. We do think that that is something that also can get done. And what's something that we're quite focused on is the fiscal impact that these pieces of legislation could have. So we think it's not quite priced in that either of these bills could probably pass. If they do pass, as well as if we actually do get Congress to pass a fiscal 24 budget that is along the lines of what we had with the debt ceiling agreement last spring, that actually could be us seeing more than $300 billion of fiscal stimulus coming into the economy this fiscal year. And that's something that we don't think is quite priced in the markets. It's not priced into debt forecasts, and it's not quite priced into GDP forecasts either.
How stimulative do you and the team expect that to be?
So, I mean, I think that one of the things that we're always looking at is that presidents try to boost the fiscal stimulus ahead of the election. And Biden is not going to be any different than past presidents in that regard. So I think the tax pieces can be quite helpful. The tax bill is, while the headline is that it's a $78 billion bill, that's looking at the 10-year score for that bill. But if you actually look at what's going to be coming out this year, we're looking at $135 billion of tax credits that could be beneficial to companies with R&D expenses and CapEx expenses. So that can be quite helpful for those companies. In addition, you get some benefit from having an expanded child tax credit that could be helpful to voters in this election. And I think also if we do actually get the budget passed, you have defense spending going up. And that would also be something that would be good for those stocks. So the stimulative effect, I think, is at least enough to, probably about 0.5% of GDP, but that's something that can still be helpful as you're trying to support the economy, make sure that there's not a downturn. And then also it could be helpful in the general election if that's something that Biden's looking to try to do.
Do you think we're ever going to be talking about fiscal austerity anytime soon?
So this is something that we've been highlighting quite a bit. So we are, obviously with the Fed having raised interest rates, we have seen U.S. net interest costs rising exceedingly high. We are now over 16% of tax revenues. Usually historically we look back, once you hit 14% of tax revenues, the US does go into fiscal austerity. We're in an election year, so it's not likely that we're going to see fiscal austerity this year. But as we look ahead into the next couple of years, as Congress needs to think about whether or not they're going to be extending the 2017 tax cuts, as they're looking at what they're going to be doing with a new presidency, that overhang of how much debt we have and how much we're paying for interest costs is going to be quite important. And we're going to have to start thinking about how do we do some fiscal austerity if we're not seeing strong economic growth to balance it out.
Jeanette, appreciate the update. As always, enjoy the weekend. Jeanette Lowe there, a strategist. If only you could have seen Bramo's face when I asked that last question. Fiscal austerity?
Look, it's
what fiscal austerity?
Okay, it's a good question, but how many years have we been talking about this? Are we going to get fiscal austerity? Well, sometime in the future, we're going to have to in order to get the budget into balance, and then it never comes because it's always an election year and nobody wants to accept some of the cuts to certain programs.
Brutal line in Politico just moments ago. A day Biden world wishes it could forget. Yesterday, just
Oof.
Brutal.
Yeah, well, and that's probably very true. It just solidifies some of the other impressions that people had, how this is going to play out. We've got, how many more months of this? 9 more months of this?
Yeah,
so
excited.
Stay tuned.
You were fed up earlier this week.
I haven't really stopped.
I can't wait to see where you're at in 9 months' time. Coming up on this programme, Deborah Aitken of Bloomberg Intelligence on luxuries Big B. And we'll get a recap of Pepsi as well. Equity futures on the S&P positive by 0.1% from New York. This is Bloomberg. 3 days of minor gains on the S&P 500. Equity futures look like this morning. Looking to make it day 4, positive 0.1% on the S&P, and the Nasdaq 100 up by 0.2%, heading towards 5 weeks of gains on the S&P 500. Decent week, even with the bond market selling off a touch, yields higher through the week, really the bulk of that coming on Monday. I'll get to the bond market in just a moment. Let's talk about earnings. The big one 2 Wednesdays away when we get numbers from Nvidia. Pepsi out, Lisa, a little bit earlier. The stock is down by more than 2%.
Basically, it missed when it came to revenue, even though it beat on profit. And we can go into all the numbers, but what I find more interesting is that Pepsi raised its dividend by 7% and said it would buy back about $1 billion worth of shares. Why I find this interesting is because yesterday I was reading some data that so far in February, there has been the greatest amount of share buybacks announced by U.S. companies ever in history for a February. And it's been one of the best starts to a year after 2023 ever. So this in terms of share buybacks announced. This raises a question. Is this because managements are comfortable because they see a better opportunity forward? Is this because they don't know what else to do with their cash and they don't know where to invest it? And how much is this really what's kind of behind some of the support that we've gotten in markets? I find this really interesting.
I want to talk about pricing power as well for some of these consumer-facing companies. That stock is down by about 2.3%. I want to talk about that because really I just want to talk about this from Michael Hartnett over at Bank of America this morning. You've seen this, haven't you?
Yes.
This is amazing. 30-second ad during Super Bowl I, 1967, was $37,500. The price for the Super Bowl this weekend, $7 million. He says that's a 185 times jump. Says nothing keeps pace with the Super Bowl inflation, but if they could, a 6-pack of beer would be $340. A gallon of gasoline would be $61. The average US house price would be $4.2 million. And the S&P 500, never mind 5K, would be at $16,374. There you go. Super Bowl inflation.
You know what this tells me? Michael Hartnett, we feel your pain. It has been a market meandering with not a lot to talk about, with flows not coming up with direction. Congratulations on finding a great angle.
Yesterday, the trading range was so tight. I think we said earlier in the programme, it was as if this market wasn't even open. We've had some price action in the bond market, so let's turn to it. 2-year, 10-year, 30-year looks a little something like this. On a 10-year right now, not even up by a basis point, 415, it's 79. On a 30-year, where we had a decent auction yesterday, up just a single basis point, 435.98. More on that later. I want to turn to foreign exchange. Less about the euro, more about the yen. We heard from Governor Ueda, who's got this to say. Even if we end minus rates, the accommodative financial conditions will likely continue. Lisa, dollar yen 149.37.
This is the reason why it's been such a hard thing to trade, because essentially it's just completely predicated on the what if that people have been talking about for so long. And even though you got a couple of weeks ago the suggestion that they were ready to start moving to a 0%, all the way up to a 0% rate, there still is sort of this pushback. We don't need to, because we're not seeing the incredible inflation that they were kind of hoping for.
That currency pair totally unchanged this morning. Under surveillance, here are your top stories. Number one, overnight, President Biden failing to ease concerns over his memory and fitness for the job. Speaking last night from the White House, Biden insisted a special counsel report on his handling of classified documents and mental state was inaccurate. After heated exchanges, Biden making another gaffe, referring to the president of Egypt, al-Sisi, as the president of Mexico. Lisa, we all forget stuff. We all get things wrong.
What?
Well, I'll do plenty on this show this morning. No doubt about it. But when you have to hold a news conference to try and make the point there's nothing wrong with your memory, and then you make another gaffe like the one you've already made several times over the last couple of weeks, it doesn't help, does it?
This is not great. Let's just put it that way. And the fact that we were talking with Jeanette Lowe and that there is some speculation that maybe Biden could hand off to another person, and she said it's not going to happen. And we hear that from every strategist. It's not going to happen. So then what is the end game for this? If he thinks he's the only person that could beat Trump, and then Jim McKelvey came on and said essentially, Trump would lose against anyone but Biden, and Biden would lose against anyone but Trump, or that there's sort of, equally not loved candidates. Why are we doing this again?
His handlers, I do wonder how this is going to work on this campaign. You go back to the previous campaign of 2020. We're in the pandemic. They joked that he was in the basement, but ultimately he wanted to make it a referendum on the sitting president, and he was successful doing so. He didn't have to campaign in quite the same way. This time around, there is no pandemic. He's expected to get out there. When you make mistakes like this, the spotlight is on him big time. Less forgiving of mistakes for this president than anyone else, given his age.
You know, I'm glad that you switched the conversation to policy earlier, because you're talking about the bill that has to get passed. You're talking about that he's going to be meeting with Olaf Scholz later today. And the fact of sort of how are you going to deal with not what his name is and who he is, but in terms of what kind of aid gets to Ukraine, how we deal with some really intense geopolitical things. That's where the focus should be. And the fact that it's not is really a shame.
The focus elsewhere yesterday as well, the focus on Russia. Russian President Vladimir Putin saying he has not achieved his objectives in Ukraine yet. Putin telling former Fox News host Tucker Carlson he would be open to negotiations if the US were to stop sending weapons to Ukraine. The Russian president also discussing jailed US journalist Evan Gershkovich of the Wall Street Journal, saying he believes an agreement could be reached to secure his release. So we talked about this a little bit earlier this week, and we said you can't cover this particular interview without pointing out that many people have asked for an interview with Vladimir Putin and have not been given one. And many people have tried to cover this war and have been locked up in Russia for it. I will say this, though. Credit to Tucker Carlson for taking on the Russian President Vladimir Putin at the end of that conversation in quite the way he did, to try and push for the release of this journalist.
Yeah, that I agree with. However, he then said, sure, you know, we just need to have some sort of negotiation at some point in the future. Again, theater. I mean, that's sort of my take on this. He did push for the release of Evan Gershkovich, and everyone is hoping that he comes back. The question is, what is the president of Russia going to demand in response?
And the aid that we're set to provide here in the United States to places like Ukraine, the fatigue is real. It's real in this country. It's real in other countries too.
Well, and he said that, right? Putin was like, well, as soon as the U.S. stops providing weapons to Ukraine, we can negotiate something in a couple of weeks. OK, what are those terms of the negotiation? Them ruling over Ukraine? A lot of things need to be developed. And the point that people can't talk with a unified voice is really becoming a problem in terms of Ukraine that's complaining that they don't have enough missiles.
That's the latest on Russia. Let's get to the latest on the earnings. Lisa went through PepsiCo. I want to talk about Hermes hitting a fresh all-time high after beating sales expectations. The maker of Birkin bags defying fears of a broader slowdown in luxury goods. On the opposite end, L'Oreal reporting disappointing results, citing a slowdown in shopping by Chinese travellers. Also this week, Kering warning its Gucci label is suffering from a slowdown in sales, but the company's CEO vowing to revitalise the brand. Gucci's been in a tough spot for a while, Lisa, but I think you look at Hermes this morning up 5%. You get the feeling that that's a stock-specific story and not any indication of what's happening with the broader luxury market at the moment.
Yeah, although I take your point about buy now, pay later. I take your point about sort of, what else do we have to lose? Doom spending, this whole idea of let's just go and buy something beautiful and go on a great experience because we can't afford to buy a house. I mean, this sort of idea maybe is losing some steam as people face reality. And maybe that's part of what's behind it, because I thought it was interesting that a firm, the buy now, pay later firm, came out with disappointing forecasts for this year, seeing some sort of slowdown in that. So I don't know how much that's behind it, and it's sort of who you're catering to versus nice silk scarves and Birkin bags.
Well, we can get to that in a moment, but buy now, pay later, that exploded over the Thanksgiving holiday. Remember, Black Friday into Christmas shopping. You wonder how things are trending coming into 2024. My line of the morning, though, comes from Deborah Aiken. She says this about Hermes. It's in a high luxury league of its own, delivering by far the highest quality among luxury peers. Deborah Aiken, I'm pleased to say, joins us now. Deborah, do you think this is a stock-specific story rather than an industry story when you look at these numbers this morning?
I do, in one way, and it always has been the case for Hermes. The growth rate, the 21% growth rate on the back of a year ago growth rate that it achieved, the way that it's building its earnings numbers, the way that it's focusing on that growth with new production facilities and staff, it's untouched. And we see that carrying on. And the biggest risk to Hermes is that it becomes a little bit diluted over the longer term, but for the midterm, we see that continuing. But there are companies now, what I thought this may come up. So there are some companies, if we look from the beginning of the year and the share price performances, we have anywhere from 10 to 20% share price performance positive from the LVMHs up to the Tapestries. Which is the owner of Coach, which we saw yesterday, delivered very well. So, and it's the US, so we look at what's happening, doing very, very well in the US, and that is counterbalancing what's happening still at the moment in China.
Deborah, you've touched on it, just how polarised this luxury market is at the moment. Can we just talk about pricing power? I saw a line from the executive chairman, Axel Dumas, who said that we could have price hikes of 8 to 9% on average in 2024. Who else has that pricing power?
He said that, but he won't do that. So we saw that certainly over the last couple of years, though. It had to be passed through. And those at the top end were passing that through successfully. And those shoppers out there were accepting it. So there were many over the last couple of years who had that pricing power. But now we start out with average share prices across the board in many luxury categories and across many brands, 20 to 25% higher. So that really means that you need innovation, new labels, collaborations and others further down and below Hermes. That doesn't say, though, that they don't pass pricing through of 2 to 4% this year. That would be where I would expect pricing to go.
Deborah, is there any macro trend that we can take from this, that companies that are less exposed to China or that are more exposed to a higher end kind of consumer are doing better? Is there anything at all? Or is this just silk scarves and Birkin bags that people like?
No, I think and for Hermes, it really is about exclusivity. So we stand that aside. And it really is delivering every sector, every region. And it's quite similar in terms of the growth rates and the trends there. But if I set Hermes aside, if we look at other companies, I would say actually that the US is particularly robust, and it's been better for most companies than we ever thought going into this earnings season across beauty, high-end, and the high end of luxury. And we see that also, even with the L'Oreal number today, where they have the US up 12%, despite a flat China market where L'Oreal outperformed with about 6%. So Europe as well. Europe is resilient against Europe being quite strong last year and advancing on the back of tourism. It's doing well too. So there's a lot going on brand by brand that you mentioned at the very beginning. There are some brands such as Gucci, such as Salvatore Ferragamo and Burberry, where they're amid strategy overhaul. And that's about really getting the brand perception into the mind of the consumer as really being elevated from where it struggled previously. That's still an ongoing thing.
Deborah, Lisa talked about buy now, pay later. If I could just jump in and get a response from you on that. It felt like that for a while that was being used for the entry-level luxury items, maybe it's, say, a Gucci. Deborah, are you seeing that change, those trends change over the last 12 months?
Yes, I think in the US in particular, on the back of the voucher system and others from the year prior, we saw the US at the entry level aspirational, particularly with the fashion brands, probably trained down from about September 22. And what we've seen through the second half of this year against those easing comps the end of last year, but we've seen that has kind of evolved a year ago. And so we're actually coming out of that and we're seeing a more robust performance at entry level. And that is actually surprising for some brands. But the brands need to be really astute. They need to be in the face of the consumer. The consumer, even at the entry level, needs to feel it's personalized marketing. And you talked about marketing at the beginning of this too, and advertising spend and how we use the cash flow. L'Oreal is an absolute amazing example of this. It's taken its marketing spend from 12 to 13.3 billion this year, 32% plus of sales. And what it talks about is tech for the future. And that's how outside of Asia, it's just growing the business so profoundly well, probably 1.4 times the market rate for that company.
Interesting.
So, it's so mixed, but there are so many interesting messages out there.
Deborah, pleased to get some clarity from you. Appreciate it. Deborah Aiken there of Bloomberg Intelligence on Hermes. Her line this morning, high luxury league of its own. Bernstein, strong brand momentum. Morgan Stanley, results very solid. The stock looking pretty decent, up 4 or 5% over in Paris, France this morning. Let's give you an update on stories elsewhere today. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden has criticized the extent of Israel's military campaign in Gaza. Biden saying, quote, there are lots of innocent people who are starving, a lot of innocent people who are in trouble and dying, and it has got to stop. His comments came after Israeli Prime Minister Benjamin Netanyahu previewed plans for ground forces to enter the city of Rafah. Rafah lies to the south of Gaza and near the Palestinian territories border with Egypt. Pepsi's shares are lower in the pre-market trade after its outlook for revenue fell short of estimates for this year. Pepsi saw profit growth for the year. Still, it saw that, citing customers' appetite for snacks returning to pre-pandemic patterns. Shares of Pinterest are also falling in the pre-market session. The company reported weaker than expected fourth quarter holiday sales. Revenue came in at $981 million. The estimate was $990 million. Earlier in the week, Snap plunged after posting similar misses. Still, analysts are positive on Pinterest thanks to a new ad partnership with Google. That's your Bloomberg Brief. John.
Hey, Danny, thank you. I miss a lot of things about TK. Number one this morning would have been his review of Pinterest.
I think so.
Every single time.
Oh my God, unbelievable. What do they do? I don't get it. I went on there for a hot second and it was terrible. It's more geared toward women, yes, and typically it is just squashed around sales. But, you know.
You see, you say that, it sounds okay. When TK would sit here and say it skews female.
Well, but it's true.
Like, yeah,
if you look at the actual numbers, it actually is true.
It's wedding lists and stuff like that.
Well, and, you know, if you want to renovate your bedroom or your kid's bedroom, then people go on this. I've gone a little bit and I haven't been able to keep my interest just because I'm not very good at these things. But I will just say this. The fact that Pinterest and Snap both declining in ad revenue and Meta crushing it.
Own world.
Right. So is it just a consolidation of market share? I mean, can you really say targeted ads from Google are really going to change the dial for Pinterest?
The big get bigger and everyone else just gets punished seems to be the story of the last couple of weeks or so. Up next on this programme, the last mile to 2% inflation.
To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
That conversation continues up next, live from New York City. This is Bloomberg. Live from New York City, stocks just about positive on the S&P 500, up here by 0.1%. Yields higher by almost a basis point, the 10-year 416.37. Under surveillance this morning, the last mile to 2% inflation.
It's a very strong labor market still. And so gratified to see inflation coming down, hoping it continues to come down. And I think we've got some time to be patient. To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
So here's the latest. The Fed tempering expectations for rate cuts until they're confident inflation is heading back to target. At 8:30 a.m. this morning, we'll get revisions to last month's CPI data. January's print due out on Tuesday. Henrietta Parkman of Allspring with a warning, writing this. We are seeing slowing growth and we are fighting the tougher last inflation innings. We have moved from a world of constrained demand to more vulnerable supply chains. Henrietta, I'm pleased to say, joins us now for more. Let's just begin, if we can, with the growth outlook, because what we've seen so far here stateside is upside surprise after upside surprise. What kind of slowing are you anticipating?
Well, it should, right? And it is true that the US has really defied gravity over the course of 2023. And to be fair, it is true at the beginning of 2024, some of the numbers that were coming out, particularly in the labor market, are stronger than expected. That being said, a lot has been thrown at the situation in terms of rate hikes. And that does take variable lags to sort of come into the economy. So it should slow. We'll have to see if it does. The positive side is that we are seeing inflation coming down.
As you know, there is a concern, though, for some central bankers that inflation stabilises above target. Do you share those worries?
I think it's a very fair question, right? As you mentioned, we are in the last innings. It is the hardest part. We're looking at the services. We're looking at some of the inflation that might be wage-driven as well. So it is the tougher part. So it really explains why the central banks are being cautious about going too soon in terms of their rate cuts at this point.
You know who's not being cautious? Everyone in bond markets, where they're basically going into as much risk as possible and people are bidding up bonds, even as the U.S. sells record amounts of them. You were pointing out you understand why, because there is something for everyone. If you want spread, if you want duration, you can go and you can find it because you're actually getting yield. How long will that look attractive if we still do see some of these economic prints coming on hotter than expected?
At the moment, you're in a situation where there's a lot of cash. You showed some of the statistics earlier today, and it's true. There's a lot of cash sitting on the sidelines, and that means that there's powder dry for investors moving into other asset classes, and that includes the bond market. I think that we'll see more of that this year. It's been really interesting to see the issuance patterns that you mentioned in treasuries. Pretty big issuance, and that's been very well absorbed over the course of this year. Again, if you look at the European markets and actually IG, you've had some record sort of inflows into the asset class. So I think there is appetite for the fixed income piece of the market. And it's not just a growth story. It is also that inflation story. We have seen inflation coming down, and that's what investors are looking at. Another aspect that I think investors are taking comfort from is that we are talking about rate cuts. It's a question of when.
So where is this cash coming from? Because when we hear from people, they say there's $6 trillion in money markets. And then we talk to someone who runs money market funds and said it's not moving. It's just growing because this is actually an asset class in its own right. Where is it coming from?
Well, it's interesting. It's feeding on itself. Some of that, you've got a decent coupon on the cash side of things, and I think that is helping. We had an interesting conversation with an investor the other day, saying that actually something that might be slowing the economy is to cut rates because it'll mean that you get less income on the cash side. So I think it's a question of investors being cautious, wondering what's going to be next from an equity perspective, maybe not quite being ready to fully go into the bond markets either, and I think that explains what we're seeing in the cash markets.
I love what you just said there because it's so counterintuitive, but it's something that people flirt with sort of in back rooms and not necessarily in public, where they say, what if higher yields are actually stimulative and lead to more inflation because people are earning income that they can then put back into markets and put back into the economy? Do you buy into that? Is that sort of more true than people realize?
I think it's something to bear in mind, and given the sort of levels of yields that you've got, across the US and across Europe, actually, in the cash market, something you haven't had in a while at this point.
Great to catch up and get your thoughts, Henrietta. Thanks for joining us this morning. Henrietta Packerman there of Allspring on what we're seeing in the bond market. So let's talk about what we've seen so far this week. In fact, let's wrap up the year so far. Tons of issuance, corporate credit, and not just investment grade, lots of supply. And it's been taken down really quite well. The demand has met that supply. This week, we had a lot of supply as well on the sovereign side of things. We talked about the 10-year slate, $42 billion of 10-year notes from the Treasury. That went pretty well. Following day, 2 days later, 30-year bond, $25 billion worth, also taken down quite well. Year to date, that supply, Lisa, has been met with pretty solid demand.
That's the unusual part of this, is that you've had a near record supply in a lot of different asset classes, and you've had the demand meet for it. And a lot of people saying there's cash on the sidelines. I just wonder where it's coming from. Because if people are satisfied locking in yields of, say, 4% on a 10-year Treasury, that indicates they think that yields are going to be lower than that over a longer term. And if you start to get nervous that inflation is stickier or the deficit will matter someday, then suddenly you start to have a different equation. Likewise, for some of these corporations, there is an expectation that they can keep rolling it over and be kept afloat by private credit until rates are going to go lower. It just hasn't really been fully assessed in markets that this is the new rate because nobody believes that it is.
High yield spreads, 321. 321 at the close yesterday. We're getting tighter and tighter. We've talked about this over the last week. There seemed to be a shift in central banking. They've been constrained by above target inflation for the last 18 months or so. I think there was a worry in markets about their ability to respond to negative shocks. Then we got some evidence of that maybe 12 months ago. Big worry in the market. We got through it. Now I think there's a lot more comfort about the ability of the Federal Reserve and this chairman to respond to a negative shock if we get one because of the improvement we've seen in CPI. And he basically told us that last week in the news conference.
If the big threat is no longer inflation, they have the tools to cut rates much more dramatically than they have for decades in order to respond to weakness. Companies also have greater resilience because of their pockets of cash if you believe that inflation is going to come down. And that, I think, is the change. You've seen the credit quality go up in a lot of these corporations. And so that's what people point to as the reason why you can see such an incredible rally.
That caveat's important, though, right? If you believe.
Right. Well, I mean, that's exactly why that is the big headwind. It is the potential for reinflation in the economy.
This conversation continues. The brilliant Jay Pilosky of TPW Advisory, and since people get jealous, I'll continue. The brilliant Greg Valliere of AGF Investments. The brilliant Jennifer Bartashas of Bloomberg Intelligence, and the brilliant Earl Davis of BMO Global Asset Management in the second hour of Bloomberg Surveillance.
It's gonna be a thing.
A brilliant hour coming up next. People get so sour when you call one brilliant and the other's not.
Am
You know,
I
do you notice that?
brilliant?
You're brilliant too.
I don't need it.
Marie's brilliant.
Everyone's
TK's brilliant.
Everyone's brilliant.
What I'm focusing on is the productivity boom. That is what's driving this immaculate disinflation we're seeing.
I can't make the case for a whole lot of upside other than momentum, which is very powerful.
The data is telling me to be risk on.
I think there's a lot of opportunities in the U.S.
We're actually seeing some signs of a reacceleration in economic activity.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500. Not doing much at all. And I have to say, not doing much at all week. It's been pretty calm, drama-free, even with some stellar economic data pushing yields higher at the start of the week, even with one bank, NYCB, down about a third, lost a third of its market cap again this week, Bramo. Things are pretty calm.
I would say it's calm on the surface, but underneath it's a battle. It's a battle
Drama,
between
chaos.
Complete chaos, FOMO versus fear, battling against one another as people try to understand what they should pay attention to more, momentum or concerns about overvaluation and the potential for a whole host of disappointments. And those two things are locked in a steady battle under this relatively calm surface.
What did Julian Emmanuel of Evercore say? Fear meets FOMO.
Yeah.
Well, What's new about that? What's the new thing to fear?
Well, there's lots of things to fear. I could tick them off. I mean, basically, high valuations are one thing that people point to. Narrow leadership is another thing. The idea that people have priced in too many rate cuts and what happens if that doesn't happen. Reaccelerating inflation, given how good some of the prints are. The fact of geopolitical conflict potentially disrupting commodity prices and shipments. I mean, I could go on, but this is my, day trade. But I'm just, people are sort of putting that across.
It's very on brand. I love that you've got the list ready to go. Let's go through a few of them. There is a worry that the narrow leadership is getting even narrower.
Oh, yeah.
You're starting to see some fragmentation in the Mag 7. I'm looking forward to catching up with Jay Pilosky of TPW about that in just a moment. NVIDIA, in about 2 weeks' time, 2 Wednesdays' time, is the final Mag 7 stock that's going to deliver earnings.
Yeah, although yesterday we did get earnings from ARM, right? And they actually did perform better than expected, saying that the AI trend is very real. So if that's any indication, there is a real secular trend here that could keep bolstering these stocks, which is the reason why people haven't been able to dismiss them. There's something real here. It's not just all fake, fluffery.
It's true. The earnings power has been absolutely phenomenal. Take Meta. Meta up $200 billion a week ago today in market cap in a single session, which is still, I'm just sitting here still thinking that is absolutely phenomenal. The big are getting bigger. The problems are elsewhere. Snap, Pinterest, you said it in the previous hour.
Basically, the big are getting bigger. They're consolidating revenue. They're consolidating market share. So don't you want to buy them? I mean, on one hand, you could say this isn't fair. This isn't good for small businesses, blah, blah, blah. But whatever the case may be, they're delivering the earnings. They're delivering the dividends. They're delivering share buybacks. And so at that point, that's really what people are looking at. And they're saying we can't discount that.
Important to recognize the United States is not the only game in town. There's one stock reporting a little bit earlier this morning, Hermes. That stock is up by, let's call it 5% over in French trading at the moment. It's up 14% year to date. It's having a decent year so far. They're not the only one. There are some names beyond big US tech which are delivering gains so far this year.
The granolas over in Europe, right? This is what people are talking about, the sort of Novo Nordisk and the Hermes and the LVMH. And here's the sort of, question. Can they really compete in some sort of mega trend in the same kind of way that artificial intelligence can in the US?
Sure. I mean, it's very different. Handbags versus AI. It's a completely different world.
Is it though?
I mean, yeah, it is. I think another change, Bramo, that's caught my eye, caught yours too. You start the year, there's a worry that we've priced in too much easing from the Federal Reserve. The Federal Reserve comes out and says, basically, and obviously they've not said this, these are my words, you've priced in too much easing. Their words are reinforced by the data. We have to readjust, yields are higher at the front end, and equities are okay. So it goes back to Stuart Kaiser's world over at Citi. So far, good news has been good news. Spreads are still tight on credit. Equity markets are at all-time highs, even as we have reevaluated and recalibrated expectations around the Federal Reserve.
You still are baking in a 1 percentage point cut, more than a 1 percentage point rate cut by the Federal Reserve by the end of this year. So basically, at least 4 rate cuts. So if you start to price in 2, like the Fed is saying, then you get a different response in equities. What's the threshold? And by the way, isn't this one of the reasons why the Russell 2000's underperformed, why some of the smaller, more leveraged companies have really struggled? So until you get a sense of what certainty you have there, can you get that broadening out that so many people are hoping for?
You see this 4 minutes into the show, 4 minutes into the hour, and not a single mention of being old, frail, and having a poor memory.
Well, speaking of which, someone just wrote in, fluffery is not a word. Nice try, TK.
Is that what they just said to you?
Which
is
great.
just said?
I mean, it's kind of true, but fluffery, I think, should be a word.
Bramo, you can make it whatever words you like, OK?
Thanks.
The equity market on the S&P 500 looks like this. Equity futures positive by 0.16%. That's a session high. We talked about it a few times in the last 60 minutes already. It's as if the market wasn't even open yesterday. Just a ridiculously tight trading range. Let's see if we break out of that range a little bit later on today. In the bond market, yields higher by a single basis point, 416.57. The euro a touch weaker. The dollar a touch stronger, 107.72 on the euro against the dollar. Coming up this hour, Jake Poloski of TPW Advisory on the record run in equities, Greg Valliere of AGF Investments reacting to Biden's latest gaffe, and Jennifer Bartashis of Bloomberg Intelligence on snack sales ahead of the Super Bowl weekend. We begin with the big story. Stocks looking to make it 5 straight weeks of gains. TPW's Jay Poloski highlighting his concerns, writing, quote, the 4-for-4 lineup seen last fall, favourable seasonality, sentiment, positioning and technicals have all reversed for the most part, leaving us cautious on US equities in the near term and looking elsewhere for action. Jay joins us now. Jay, before we get into the elsewhere, because I want to talk about China and Europe with you, I definitely do, and Japan as well. Let's just focus on the US. What isn't there to like when this group of US tech stocks keep delivering the earnings they're delivering?
Oh, no, John, I mean, we're constructive. It's just that we've had a big run, and it's important to realize that the factors that were really attractive to us back in November when we were constructive, unlike most, have now reversed, and that's just reality. And so we want to live in reality. In terms of the U.S., I mean, I think the issue is a failure of imagination, a collective failure on Wall Street of imagination. And I'll give you 2 examples. The first is the consensus for GDP growth this year is about 1.4%. Even though we're basically what the Atlanta Fed nowcast for Q1 is at 4%. And then second, and even more telling, is that the consensus for year-end S&P is 2% below where we are today. And so I think it's time that we kind of expand our horizons, broaden our focus, and think not just about a good 2024, but a multi-year period of a good environment, of macro stability, of rising productivity, of decent GDP growth and good earnings growth. And that's really the focus. And so what we tried to do with that comment was to kind of tell people, hey, the real fat pitch, I know it's football season, but the real fat pitch was in November in the U.S. Right now, it's okay. It deserves a rest. It's going to take a rest at some point. It's going to pull back a little bit. The question is, what do you do then? You should be a buyer. We're very constructive on AI and tech. Completely disagree with the idea that we're approaching a 1999 moment. As Lisa and you were just chatting about, these tech companies today are cash-making machines. Unlike in 99 when it was pets.com, which was absolutely nothing but pets.com. And so we're in a very, very different environment on the tech side. And we're looking now for opportunities elsewhere where the rest of the world is kind of catching up. The U.S. has been the clear leader coming out of COVID, the global growth leader, stock market leader, led by tech, but it's pulling everything else up.
But Jay, hold on a second, because you're talking about pulling everything else up. So weight loss medication and luxury, is that pulling that up? I mean, we're talking about granolas over in Europe as something that people are trying to lean into, which includes Novo Nordisk and LVMH and a whole host of others, including Hermes we just got today. Do you buy that that is a similar type of trend as artificial intelligence that people say is transformative.
Well, it's funny you say that, Lisa, because there's the Magnificent Seven in the U.S., and we're actually looking right now and adding right now to what we're calling the Magnificent Six, us and a few others. And it's not just Europe, it's IFA, and it includes many of the companies you just mentioned, LVMH, Novo Nordisk, AstraZeneca, but it also includes ASML, which is critical to the expansion of the semiconductor industry, and SAP, the German software company. So there is technology in Europe. And what's interesting is there's technology even in emerging markets. I was looking just the other day, in the number one sector in the broad EM index is technology at 20%. And guess what? The broad emerging market index just broke out and above its 200-day resistance level. So ACWI is hitting a new all-time high, global equities. So yes, it is a broad move. It's led by the US, but ACWI, global equities, are hitting new highs. Emerging markets breaking above their 200-day average, which includes a 25% weighting in China. If you look at EMX China, it looks very much like the US in terms of the chart.
Jay, I know we're friends, but we're being way too kind by just focusing on Europe. You mentioned China. Let's go there. The most unloved equity market on the planet right now. You raise your group with this to say. We caught up with Anna Ashton yesterday and the team. A continuation of the current approach to equity market volatility, which includes state buying, administrative controls, financial crackdowns, unlikely to provide more than a few weeks of reprieve. Instead, it entrenches the sense of malaise and weighs on confidence. I know you took a sip of the drink. You know this is coming. Jay, when is this going to change?
Water, John.
What is it going to change?
Well, look, you know what? I think the environment that we saw back in November in the U.S. is now to be found in China. Absolutely rock bottom sentiment. Seasonality typically quite good around the Lunar New Year. Positioning obviously horrible, right? Everyone's puked out China. And technicals are very good. Capitulation, if you want. Some people are calling it capitulation. Others are saying that technicals are extremely compelling for a significant bounce. And I look at things like, and we own China, right? And you know that we've been talking about it for a while. We were quite constructive last fall. It was wrong. It was the worst call we had last year. But we resized it. We shrunk our position and narrowed it down to the tech sector. And I'll just note that KWEB, which is the thing we're playing, the ETF, is well above its lows of last year. So it's about 10, 15% above. So it is not, even with all the negativity, it's still above the lows of last fall. Fall of 22, October of 22. So a year and a half now, give or take. So, my point is that all the things that were appealing about the U.S., which we talked about at the lead, has now shifted over to China. They worked really well in the U.S. and everybody was very skeptical, and we're up 20% in 3 months.
But
Could
Jay,
China be up 20% in 3 months? Absolutely.
We just have a bit
and
more.
In the interim, it's not performing. It's a drag on the portfolio. But other things are working, which should give you a willingness to hold something that you think has upside, even if it's not working at the moment. And by the way, it's completely uncorrelated with the U.S., right? U.S. shooting up, China shooting down, completely uncorrelated. At some point, the U.S. will take a rest. China will move. And that's how you run a portfolio that's going to work, over time.
Hold on a second. Bear with me. We just have a little bit of time left. I love that you can tell how much pushback you've gotten and how frustrated you are trying to justify why this is a call that you're going to stick with. I'm just wondering, though, about sort of the logical leap here that China could recover, but that won't cause inflation to reignite in the rest of the world, and that could be problematic to your thesis. How do you deal with that?
Yeah, no, you're right on it, and Lisa, and I'm going to write about that today in our musings. Because I think that I'm starting to develop the thought that China kind of being a laggard here is constructive, because if China was firing on all cylinders and the U.S. firing on all cylinders, yeah, you might get some commodity type inflation. And so maybe that we're having a staged, asynchronous recovery globally, which I think we are very much in the early cycle camp, is constructive. And I'll leave you with one thought here that's happening right now as we speak. TLT, long duration treasuries in the US, just breaking down below its 200-day support level here in the last few days. GSG, global commodities, breaking above the 200-day resistance level. Yeah. I think the next move will be a weaker dollar, which is going to give support to more of the non-US action as we see this play out a little bit. We're constructive on low inflation, but we're watching this relationship. TLT breaking down, commodities breaking out, dollar will be next. Rest of the world has a chance to catch up a little bit to the U.S. while the U.S. takes a rest.
Jay, we got to go. We weren't expecting such a long monologue on China. I just want, in one word, Super Bowl, Sunday, pick a team.
Oh, my gosh, yeah, going with the 49ers.
OK, Jay, it's good to hear from you. Jay Pawlowski of TPW Advisory. Jay is the only guy I know who would pick out his losing bet and turn around and say, you're welcome.
Exactly.
It's good news.
Saying that basically, I'm going to tell you why you're going to miss out so big if you're not in this, and that's what we heard.
It's a good job China didn't deliver because XYZ. Let's get you some top stories from elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bankers at Barclays are facing a brutal bonus season. A slowdown in deal-making and capital markets activity is forcing the bank to cut payouts for a larger than usual group of its lowest performers. Executives are also planning to shrink the overall bonus pool. Sources say junior bankers are likely to be spared, and top deal makers may still see an increase of up to 10%. Shares of ARM surged as much as 48% on Thursday. The chip designer posted a blockbuster earnings report boosted by AI. Speaking to Bloomberg, CEO Renee Haas said the company is still in the early stages of AI and is not, quote, in any way, shape, or form a hype cycle. ARM's bullish outlook helped send its shares to the biggest daily gain since it IPO'd last December. L'Oreal shares are down after reporting disappointing sales. It was hurt by soft demand in China, with shoppers reining in their travel spending. Shares had been trading near an all-time high prior to the results. Analysts had thought L'Oreal was faring better than its rivals, particularly in China. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, the president taking a defiant tone.
My memory is fine. Take a look at what I've done since I become president. None of you thought I could pass any of the things I got passed. How'd that happen? I guess I just forgot what was going on.
Live from New York City, that conversation up next. This is Bloomberg. Equities on the S&P 500 going into the opening bout a little bit later this morning. Slightly positive on the S&P by 0.14%. Yields up a single basis point, 416.96 on a 10-year. On a euro, slightly weaker against the dollar. Negative here by not even a tenth of 1%, 107.72. Under surveillance this morning, the president taking a defiant tone.
My memory is fine. Take a look at what I've done since I become president. None of you thought I could pass any of the things I got passed. How'd that happen? I guess I just forgot what was going on.
In December, you told me that you believe there are many other Democrats who could defeat Donald Trump. So why does it have to be you now? What is your answer to that question?
Because I'm the most qualified person in this country to be president of the United States and finish the job I started.
It's the latest this morning. President Biden defending his mental fitness, pushing back on a special counsel report over his handling of classified documents, which described him as a, quote, sympathetic, well-meaning, elderly man with a poor memory. Concerns about his ability to serve growing ahead of November's election. Greg Valliere of AGF Investments writing this. Democrats we've talked with are increasingly inclined to call for a meeting with Biden, diplomatically suggesting he should step down. But that probably would infuriate him, which has prompted some Democrats to look at the 25th Amendment, which lays out a scenario that would lead to his ouster. Greg, I'm pleased to say, joins us now for more. Greg, let's get into that. The Democrats you've spoken to, senior Democrats, senators, who are these people?
Yeah, they're people on Capitol Hill who are increasingly worried, John, about a loss of the House, Senate, and White House in the next election. They fear that Biden could drag candidates down, and I think that's a legitimate fear.
Greg, is this because they're worried about his mental fitness, or is this because they're worried about the political ramifications around him continuing as the leader of the Democratic Party?
I think it's both. And just yesterday afternoon, when I was starting to feel they were picking on him and maybe it wasn't fair, he got the president of Mexico and the president of Egypt mixed up. This has been an extraordinary week for Biden, with one gaffe after another. And you have to ask the question, is there going to be more? And I think the answer is yes.
So people are worried about angering him. Is there anyone around him to have an honest conversation about how to build up leaders within the Democratic Party around him so that if something does happen, he can do some sort of handoff?
He's pretty isolated, Lisa. I think, his wife, Kamala Harris, there are people who can talk to him, his son, who can talk to him and say, you've done a great job for almost 4 years. Maybe it's time to retire. But right now, I think that's still a long shot. And that's why the Democrats are increasingly worried about a really tough election.
Greg, what would the selection process even look like if he was to go down that path?
Well, the 25th Amendment, John, to the Constitution stipulates that cabinet members, a majority of cabinet members, must certify that the president has become incapacitated. That's very subjective, obviously. But if a majority of cabinet members said that could lead to his ouster. But I don't think that's remotely imminent.
Greg, the compare and contrast yesterday shouldn't be lost on anyone. The former president was facing a Supreme Court hearing on whether he could even run in the election in 2024. And somehow yesterday ended up being a win for the former president and a loss for the sitting president. Greg, how are we going to frame this going into 2024?
Well, you've got the former president who's bombastic and aggressive and shows pretty good energy. And I think the American voters are dismayed. I travel a lot and talk to people who say, this is our choice, Biden and Trump. And you have to wonder, is there anyone else at this late date? No, I don't think Robert F. Kennedy is a serious threat. Maybe if Nikki Haley catches fire, or maybe if she starts thinking about running herself as a third-party candidate, that would be intriguing. But right now, we got Biden against Trump, and that for many Americans is not an appealing scenario.
Greg, is there any historical analog to this moment?
Well, I pointed out in my piece this morning, in 1919, when I was just starting out in this business, Woodrow Wilson had a debilitating stroke. And for the rest of his second term as president, Edith Wilson, his wife, ran the government. I don't think we're in a situation like that now, but presidents get sick. Ronald Reagan was starting to falter at the end of his second term, but the Woodrow Wilson one was a serious one. He did lose a lot of his mental acuity.
A lot of people are looking to try to understand what the policy prescription is here and how this sort of relates to what gets passed or not down in Washington. I just wonder how some of this drama plays into getting Ukraine and Israel aid passed and some of the other just sort of nuts and bolts of D.C.
With all of this about Biden and Supreme Court hearings, things like that, we got stuff to do. There's things that have to be done. By early March, there are 2 deadlines to keep the government open, and no one's really talked about getting a budget done. But they're going to have to focus on that in the next couple of weeks. And as you suggest, there's aid to Ukraine. I'm a little more optimistic. Ukraine will get something, but I don't think they're going to get $50 billion. That price tag is a little too rich.
What number are you expecting, and what underpins that optimism?
Could be 20 or so billion. Hard to say, but I do feel that there's a growing anxiety that Ukraine is beginning to falter. And we see a new general appointed yesterday by Zelensky. I think the idea of a faltering Ukraine really unnerves people in Washington. So I do think it may be still a months away, but I do think Ukraine will get some aid.
Hey, Greg, appreciate it. Appreciate your opinion this morning. Greg Valliere there of AGF Investments. It's being taken very, very seriously. Lisa, what's taken place in the last 24 hours?
Yeah, with respect to the 25th Amendment, is that what you're talking about? This idea that people are actually talking about what would be required to not just have a hard conversation, but actually take action. That's pretty notable. It's a pretty notable view that
it's amazing, isn't it? You and I have talked about this a few times already this morning. I think it's worth going over once more, that we're not talking about the fact that the former president had a hearing yesterday about whether he could even run for the election this year. And somehow yesterday was a big win for him And a loss for Biden after last night's performance.
Yeah, I think a lot of that, the legal dramas and the legal intrigue around Trump have been really creating just more noise and used as a campaigning tool for him to raise money.
The news conference yesterday evening made this situation even worse.
I know. Again,
and it already was.
Where are the handlers?
Don't know. Equity futures on the S&P positive 0.1%. Coming up next, Jennifer Bartashis of Bloomberg Intelligence on snack sales ahead of Super Bowl weekend. Live from New York City, going into the weekend, a few hours away from the opening bow, 2 hours away. Your equity market on the S&P 500 looks a little something like this, positive by 0.16% on the S&P, on the Nasdaq up by 0.37%. The Nasdaq 100 with a lift. The next big stop for that equity market, the next scheduled stop anyway, is going to be Nvidia earnings in 2 Wednesdays' time. In the Russell, the small caps positive by 0.4%. In the bond market, we have taken a ton of supply, more than $40 billion of 10-year notes earlier in the week, $25 billion of 30-year bonds yesterday, met with some really resilient demand. Yields are higher on the week, particularly after the data we got on Monday. The ISM services read really quite strong. The 2-year closing the week very close to 450, up 2 basis points to 447.57. The 10-year also higher by 2 basis points to 417.34. Lisa, 1 hour from now, CPI revisions front and centre, particularly after what Governor Waller said last month. My hope is that revisions confirm the progress we have seen, but good policy is based on data and not on hope.
It shows how messy it's been post-pandemic with some of the data, and that there have been more discrepancies in the gap between some of the reported numbers and the revisions with seasonal adjustments made have been pretty great. And I'm not saying that this is sort of, manufactured numbers and all of the conspiracy theory that some people put out there, and they'll comment to me all the time. It's not that so much as it's harder to get a read when you've got fewer people responding to surveys and you have different types of trends that are muddying some of the picture.
So let's look at what they're doing. Spending. Let's look at retail sales. Bank of America put out a note yesterday. I'll share this quote with you. With real income growth picking up due to a strong labour market and continued disinflation, the risks to consumer spending are increasing to the upside. To the upside. Bear in mind, for the likes of B of A, they were looking for a cut in March, pushed it back out to the middle of the year. Barclays too, Goldman as well. So a few of those banks need to push that out because the data has been decent. It's been pretty strong.
And it's been confirmed by a lot of people, seeing revenues potentially coming in stronger than expected. And yes, it's because credit card outstandings have gone up. But the American household is less leveraged than it has been traditionally. And what you're seeing is real wages starting to go up. And so all of a sudden you have to wonder, okay, again, which is going to go to meet which, right? Are we going to see services go down to manufacturing or manufacturing go up to services? We're seeing manufacturing excel and you see services staying high, and that's where we're at.
Manufacturing really picking up, and after being really terrible for the best part of 2 years, a year and a half, very close to getting into expansion territory. Want to finish on foreign exchange. The new number we've talked about all week, 105. Jane Foley, Rabobank, 105. SocGens, Kit Jukes, 105. Looking for the euro to drop to 105 from 107.67, primarily because of that conversation we're having, Lisa, about better data in America and a struggle over in Europe.
Bold call, 105.
Go all very close,
down.
Aren't we?
It's just basically showing that we're going to meander with the dollar slightly stronger, which seems to be a feeling, at least for now, for a lot of people.
The two things you hate at the moment, politics
just two.
And the euro, seem to be top two.
Well, no, the euro, I think, is an important story, but it just isn't one that's changing very quickly. And then you have politics, which I guess you could say the same thing about.
107.66, we're negative 0.1%. Under surveillance this morning, President Biden pushing back on concerns over his fitness for the job. A special counsel reporting on his handling of classified documents, noting Biden's, quote, diminished faculties and faulty memory. Biden arranging a last-minute press conference to address the comments, only making things worse with a new gaffe, referring to the president of Egypt as the president of Mexico. Awkward, really awkward. You want to clean this up, you hold a news conference and then you finish it like that. Not great.
Again, it really raises a question, who's around him, who's advising him? And then, how much pushback is he going to get from other members of the party? I really keep going back. I keep thinking about what Greg was just talking about there, saying that there are senators and people around him seriously considering the 25th Amendment. I do wonder, though, is his concerns about mental fitness, or is his concerns about political ramification and a greater chance of him losing versus Donald Trump? I can't tell.
The second point is super important. You see how this plays out at the polls. You can tell how Americans feel about this issue of age for this particular president. It's a problem. President Trump, former President Donald Trump, not that much younger They don't have the same concerns in quite the same way. And I think we've talked about this a few times, and it's always worth repeating. We know plenty of people of a certain age, around 80, who are still really mentally very sharp, can hold a news conference, deliver it, take questions,
100%.
Bite back, all of the above. It's not just about the age. It's about the performance. It's about the performance under pressure in a news conference like yesterday, and you make the same mistake you've been making all week over the last 2 weeks.
Here's my frustration, is that no one's having the real conversation of why are we not having real other leaders who are younger coming to the fore. And one of the big reasons why is because there are identity crises in both parties. Who is going to really represent the mainstream in parties that are increasingly polarized? So what you get is people going with sort of the standard bearers. And this really is raising a problem because a lot of people are feeling pretty alienated by a race that they don't want. And I think that's really a question. Well, how do you then cultivate a new consensus in each party and just for the nation? And I don't really see how that's happening on either side.
They can't win their primary. Let's take what's happening in the Republican Party
Couldn't
right
agree
now.
more.
Nikki Haley can't win the primary. Look at the head-to-head with Joe Biden. Absolutely crushes Biden on a head-to-head at the national level. Can't win a primary.
Have you heard anybody really question the primary system? No, because this is basically entrenched. So then how do we evolve from here? And I don't want to get on my soapbox, so I'm just going to stop.
Well, you can. I mean, you know,
I know, but nobody really wants to hear it. I mean, come on, let's move on.
We will move on to this from Russia. So Russian President Vladimir Putin said the country hasn't achieved its goals in Ukraine yet. In an interview with former Fox News anchor Tucker Carlson, Putin saying, quote, "We're conveying to the US leadership that if they really want to stop military action, they need to stop supplying weapons, saying if they do, then the war will be over in a few weeks." President Biden expected to discuss aid for Ukraine with German Chancellor Olaf Scholz at the White House this afternoon. That's going to be one to watch, Lisa, later today.
Especially because there is this bill that is moving through the Senate to provide $50 billion of aid, although we did just hear from Greg Valliere that he thinks the number is probably going to be closer to $20 billion. But coming at a crucial point, Olaf Scholz, I'm sure curious how that conversation goes with the money that they've put up for this and what they're asking for Biden that he can actually provide, given some of the disagreements in Congress.
Do you want less politics and to do a little Super Bowl, some sport? Counting down to Super Bowl Sunday. Food and beverage sales expected to rise nearly 13% from a year ago to 8.8 billion. Bloomberg Intelligence saying the jump is partly fueled by demand for snacks, which are expected to climb by nearly 14%. Jennifer Bartasha, senior packaged food and retail analyst, writing, quote, "Consumer spending has been dampened by higher inflation, but the Super Bowl should still spur demand as consumers see the game as a holiday occasion to indulge." Jen joins us now for more. Jen, can we talk about TV audience before we get into food and beverage sales? How big is this going to be this Sunday?
Well,
and why are we watching? Are we watching for the sport, the commercials, or Taylor Swift?
Yeah, we're expecting that that almost 69 million people are going to be tuning into the game this year. That's 7% higher than most of the estimates going into the game itself. And we attribute a lot of that to Taylor Swift. Because you've got a much broader audience that is being pulled in because of the personal romantic dynamics as well as the halftime show. When people do tune into the game, about 45% of people are actually there to watch the football game. 41% are there for the ads, and about 33% tune in just for the halftime show. So you've got a nice diversity in terms of why people are watching the show and when they're going to be tuning in.
Jennifer, can you give us the straight line from people interested in Taylor Swift to drinking Pepsi?
So when we're looking at this overall, you guys were just talking about politics and you were talking about war. This has become almost a holiday. People find the Super Bowl to be a reprieve, and so we're seeing just a lot of anticipation, a lot of excitement around the event itself this year. And so there's a lot of snacking occasion, there's a lot of food occasion, and everybody seems to be planning to tune in.
I'm just curious about how some of these food companies are going to be advertising. I was struck by this particular statistic. More than 40% of commercials shown during last year's game featured celebrities. This year is expected to be the same, including Lionel Messi from Michelob Ultra, Jason Sudeikis, and Dan Marino. There are a whole host of others. I've seen Serena Williams about 15 times. How much is that sort of the holy grail at a time where kind of the eyeballs have moved to Instagram, to Twitter, to maybe not there, but some other places as well?
Well, advertising has become a new form of entertainment, is really what it comes down to. And obviously, a lot of companies put a lot of effort into the ads this year. And what we're seeing is that the advertisers are a little bit more diverse this year because they're expecting more female viewers. So we're seeing ads from the first time for companies like L'Oreal or some of the cosmetic companies. So it'll be an interesting mix. But really, it's they're pulling the talent that they think is going to entertain people. And that's really the trend that we're seeing.
Jen, do you think that the food and beverage mix that they actually start to promote is going to change, not just because of the interest from, say, increased female viewership off the back of Taylor Swift, but also because of the push for Ozempic, going into this post-Ozempic world in America? Is what they advertise going to change as well?
Certainly there could be some changes in what they advertise. With regards to snack and food sales, when it comes to something like the Super Bowl, whether you're on a diet or not on a diet, it usually kind of goes out the window a little bit, and most people look at it as an opportunity to sort of splurge. And when we're talking about snack sales, it's just for this week going into the Super Bowl. There could be longer-term trends for sure, but we think that this will be a time when people sort of indulge a little bit in those snacking occasions.
It's treat weekend, apparently. Jennifer, thank you. Appreciate the update. Jennifer Bartashis there of Bloomberg Intelligence. You wonder, Brahma, how this is going to change in the years to come.
Well, I think that's probably the question and the worry of some of the executives of some of these companies based on recent reporting, right? Wasn't there reports that Novo Nordisk's CEO got anonymous calls? He wouldn't name what they were.
A couple of CEOs from, say, food companies have been calling me. They're scared about it. Yeah. There's the quote.
Yeah, so I wonder what they're asking. In public, they're saying, we've got other things that people can have. It's not a big problem. And then in private, how bad is it going to be?
They're worried about how quickly they can ramp up production of some of these drugs, particularly companies like Novo Nordisk. Because if they can, you already know, demand is through the roof for these drugs.
It's wrap-up demand, and it's also insurance coverage. It's how cheap can you make these drugs? How fewer side effects can you get? All of these types of things. And then, how much does it change people's tastes in a way that not only are they going to eat less, but they're going to crave maybe things that aren't the snacks that people eat.
What did Danone say? That they were going to be OK because people would demand high-protein goods. Did you see that?
Yeah. Well, we talked to Coca-Cola in Davos, and the CEO is saying it's not a big deal because we provide a lot of water.
We've got
and
Diet Coke
and Diet Coke
all of that stuff.
People want that.
Exactly. For breakfast, apparently, as well.
Really? You're going to troll our control room?
That's what I hear.
You gather?
No, I'm told that people actually do that.
He said that was fine. He said he welcomes it.
As the CEO of Coca-Cola, I have no doubt that he thinks that's fine. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden has criticized the extent of Israel's military campaign in Gaza. Biden saying, quote, there are a lot of innocent people who are starving, a lot of innocent people who are in trouble and dying, and it's got to stop. His comments came after Israeli Prime Minister Benjamin Netanyahu previewed plans for ground forces to enter the city of Rafah, which lies to the south of Gaza and near the Palestinian territory's border with Egypt. The panel that blew off a Boeing jet during last month's Alaska Air flight showed signs it had moved prior to the accident. That's according to Senator Maria Cantwell, who was briefed on the situation by NTSB. Investigators found marks on the panel indicating it had shifted prior to breaking loose. In a statement, Alaska Air said that there was, quote, no indication of issues with the door plug prior to that flight. Inter Miami star Lionel Messi's failure to take the pitch in last Sunday's friendly football match in Hong Kong has cost organizers more than $7 million. Spectators were left disappointed when the World Cup winner was sidelined by an injury to his abductor muscle. Some had paid more than $600 a ticket, with organizers now offering a 50% refund. Messi was fit enough to play in Japan a few days later, adding insult to injury for fans in Hong Kong. That's your Bloomberg Brief. John.
Brutal. Danny, thank you. I'll be even more brutal. Can you imagine paying $600 for an MLS team without Messi? I mean, seriously.
I understand why people were upset. I also think that this sort of speaks
furious, not upset.
But would you pay $600 to see one person play?
Someone like that, sure.
You would?
Sure. I mean, let's go back in time. Let's say I give you the opportunity to go back to the late 90s and watch Michael Jordan play for the Bulls.
All right, fine.
Would you pay up $600 for that?
All right. But it was an abductor muscle, so you have to understand.
It's one of those moments.
Yeah, well, I mean, I feel for them. It's funny, though, that they were particularly insulted that he played in Japan. It's like, really? He can play for them, but not for us? Okay. It's like, we're going to be snubbed 2 days before.
With it?
Yeah,
like Japan was a more important market
100%,
somehow?
Yeah.
Okay.
Which some people say maybe it is.
Interesting. Up next on the programme, concerns over bond supply continuing to ease.
I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in?
And at those auctions, they've been piling in. That conversation up next from New York. This is Bloomberg. Equities on the S&P 500 positive here by 0.2% going into the opening bout. A little bit later this morning, equities doing okay. Yields higher by 2 basis points, getting closer to 420 on a 10-year, closer to 450 on a 2-year, 417.54 on a 10-year this morning. Under surveillance, concerns over bond supply continuing to ease.
Between Treasury supply and corporate supply, I'm worried there's simply not enough. I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in?
Here's the latest this morning. Yields holding steady as strong demand for bond auctions this week reduced concerns about oversupply. Earl Davis of BMO remaining constructive, saying this: we will extend duration and long positions on any rate sell-off. We expect yields in 2024 to stay within the yield range of 2023. Earl Davis, I'm pleased to say, is back with us. Earl, let's get into that and start with the supply. That supply has been taken down really well, not just from the sovereign side of things with some big Treasury auctions this week, but also over the last month or so, lots of credit supply, corporate supply coming to market too. What are the forces behind that really durable, quite strong, robust demand?
Well, I wouldn't call it durable. And the reason why I wouldn't call it durable is there's one buyer out there right now, and it's retail. You know, sovereign wealth funds aren't buying, central banks aren't buying, even U.S. banks aren't buying treasuries as much as they were previously. So we have one buyer out there, and that's retail. Very large buyers, still a lot of money on the sidelines. The reason why I wouldn't call it durable, retail is a fickle bunch. The reason why they're buying now is we've had less volatility over the past 3 months and declining yields. Everyone looked at their statements at the end of January and saw that they didn't lose money on fixed income in 2023, which emboldened them further. We don't think it's a bad thing to buy bonds and durations now. We're at +1 versus a max of +3 in regards to overweight. But you have to realize that retail is a fickle bunch. And for example, if we get a surprise CPI number next week to the high side and you start seeing volatility in the market, you know who's the first to retrench? Retail.
Interesting. So, Earl, this raises the question then. If you question the durability of the demand of the year so far, which part of fixed income do you think is more vulnerable?
Oh, 2 years. 2-year bonds, without a doubt. You know, part of what we were saying last year when we think we'll stay within the range of this year is that our favorite tactical trade, and it still is, and it's been treating us extremely well, is short U.S. 2-year treasuries. Why? U.S. 2-year treasuries even now are at 450. The overnight rate's at 525. You sell those bonds, you invest the proceeds in the overnight rate at 525. Positive carry and significant positive carry, as well as, you know what, we've heard people talking about the resiliency of the U.S. economy. We believe in it. We've been talking about that for the past year and past few months. We think that will continue and push out when the possible Fed easing cycle starts.
There are two questions there, Earl. Whether this is just a positioning kind of tactical play where you're just sort of capturing the difference, it's sort of an arbitrage play, versus a true bet that we're going to get higher rates for much longer and that the market is completely offsides with some of the rate cutting bets. Which is it?
Well, the quote you put up for me from last year, you know, the high of 10-year bonds, for example, was 5%. Right now, we're at 417. So the reason we're at +1 duration is in case we do get, there's a lot of things going on in the world geopolitically, and we do think it provides a flight to quality protection. Having said that, the underlying dynamics point to higher yields, you know, so we wouldn't be surprised to see a test of 450 at that level. We go +2 long overweight duration. And then the high of last year was 5%. I don't believe we go above that, but do we go north of 250 or higher than 450? Sorry. Yes, it's a possibility.
How much are you looking at the auctions? We saw the 3 of them this week, and they all came in pretty successfully with yields below where the yields were trading before the sales, and yet they were record levels. When will they start to demonstrate some sort of investor pushback, or do you expect this to be the new status quo?
Yeah, so the thing, I've been in this market for 30 years. So the thing you realize with auctions, it brings in a selective type of buyer, someone who needs scale and size, hundreds of millions of bonds, if not billions. So those people come in, it's called a liquidity event because they could buy scale. But you know what? The levels right now are higher than all of the auctions this week. And the reason why they are is because those buyers don't come back until the next auction if they need more bonds. Likelihood is they may or may not, and the auction should do all right. But what worries me is where does the market reprice in between the auctions? And that's why we're seeing this kind of, even though we're steady today, you're seeing this drift higher in yields. You know, people are worried about the data, worried about the impact on the start of the easing cycle. So there's a lot of different dynamics here. Understanding the nuances underneath the market is what makes active managers, right? We're off to a fantastic start this year, despite not having huge amounts of risks. It's specially placed risk because of the dynamics that I'm speaking about are very persistent.
Oh, you mentioned the data. Can we talk about the data that's coming out a little bit later this morning? 8:30 Eastern time, we get inflation revisions. Could you frame for us all just how important that might be to you?
Yeah, it's not that big to me. And the reason why it's not that big is on Tuesday, we get actually CPI. And the thing I'm looking for in CPI is core. And from our estimation on base effects, core is going to be very, very sticky for the next 4 or 5 months because of where inflation was last year at this time. So that's going to keep pressure on the markets. The other thing I'm looking for is what's sticky in core is services inflation. And a leading indicator of services inflation is wage inflation. They feed upon themselves. So that's what's worrying me from a risk perspective of something being different than what the market's anticipating. So those are the dynamics and things that I'm looking at very closely.
How long do you think we can still see this idea that good news is good news, right? Especially because you are concerned about some of these wage gains. Right now, it does seem to be that case. Is there a threshold at which the concern about reigniting inflation trumps some of the ease of just a robust economy with people spending?
That is a great question. So to answer your first question, I see how long is good news good news? I think it's going to be all of 2024. And the reason why I feel that is just the large fiscal deficit. You know, people stop talking about that. What's driving Treasury supplies? The large deficits. Those are dollars that go from the public to the private, people's pocket, keeps them employed, keeps income. And you're getting the financial wealth effect as well too. So I do think risk assets will be resilient as well, in line with the economy this year, driven by the deficits. To your question, when does inflation come back into the picture and start worrying people? I think that's a big second half of this year story. Or, you know, we're starting to see real income really increase here with the disinflation, at least temporary in my mind, that we've spoken about. What we're also going to see possibly is the increased shipping costs flow through in about, 6 to 9 months. These things have long lags. So the way our team is looking at it is the first half of this year is a story of growth and resiliency and surprise upside, which we're seeing. The second half of the year is a story of inflation reemerging.
What do you think corporate credit looks like in terms of performance in the second half of the year against that backdrop, Earl?
That's another great question. So two aspects of corporate credit. We're pulling back from high yield bonds in corporate credit. The reason why we're doing that is, that maturity wall that people are talking about is coming. It starts this year and it's next year, the following year. That means high yield credit companies or corporations have to roll over, reissue debt. Debt right now is about 200 basis points higher than where it was when they initially put on, which we think will impact defaults. So we could see defaults increasing in high yield. Because of our view of the economy and its mix, and the volatility is probably our highest conviction thing, we like credit, but we're selective on credit. We're looking for episodes where things widen out to go long, similar to our duration strategy. And actually, you know what? We like financials very much. We think the spreads are attractive. They're tighter now, but when they widen up, that's an area where we do go overweight. So that's kind of our overall view on credit. Like IG, constructive, but you have to be selective on the credits that you take, and moving away from high yield, at least now, until spreads widen there.
Oh, this was quite a view. I'd love to continue this conversation in a few weeks' time. Oh, Davis there of BMO Global Asset Management with a few calls to get into there, Lisa. Two very different halves for 2024.
Yeah, although good news being good news through all of 2024, thanks to fiscal spending and the deficit. But this point of the inflation concern really picking back up in the second half and creating some headwinds. He likes financials. I know that was interesting to you.
Yeah, somewhat contrarian given what's happening in some of the financials, the smaller banks at least, but on the equity side, and we've seen some of the damage done over in Europe on the bond side of things as well.
Yeah, but basically saying when it comes to high quality, you can get there and you can capture some of the income. The tight spread, so this goes again to valuation.
320.
Exactly. People getting concerned. Maybe just everyone's gotten over their skis with their bullishness.
Oh, Davis of BMO, just fantastic. Coming up next hour, Tom Kennedy of JP Morgan, US Air Force veteran David A. Deptula, now of Academy Securities, Dana Peterson of the Conference Board, and Barton Crockett of Rosenblatt Securities from New York City, taking you towards the weekend. Equity futures are positive. This is Bloomberg.
Every week that passes, the expectation about how much the Fed's going to cut rates gets less.
It's going to take more time for cuts than people would like.
We have a Fed that we've had some walk back of if March is on the table or not, but I think the base case is still their next steps are easing.
We're in the same camp as the Federal Reserve. We need to see more data.
We look at rates and where the Fed is today. The Fed has gotten us to where we need it to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
And let's get you to the weekend. Live from New York City. Let's get me to the weekend. That's what that felt like, right?
That was so...
From New York City this
personal.
morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market positive here by around about 0.1% on the S&P 500. Lisa, heading towards a fifth week of gains.
And frankly, the optimism is just palpable in terms of the economy. Maybe some people raising some wall of worries thing, but I get the feeling people are sick of worrying. I get the feeling that people are sick of being wrong. And so they're saying, yeah,
how personal is this?
Well, no, I actually am really not sick of being, concerned about things, but that's just my nature. But I really have felt that from people, that the wall of worry has proven an inaccurate guide again and again. So people are just dismissing it and going with momentum.
I'm going to sound like a broken record, but I think they're comfortable with this idea that the Fed can now respond to negative shocks. And that when you see a difference in a stock like NYCB, down a third again, lost a third of its market cap again this week, it's been absolutely hammered. We seem to have ring-fenced that, parked it in one corner of the market, and equities have carried on drifting towards fresh all-time highs, and high-yield spreads are at 320, which is kind of amazing.
It's a great point. It only works with them having the ammunition to fight downturns, not an increase in inflation, not an increase in acceleration in the economy. And even though we're getting better than expected economic data, people still have parked the idea that inflation's going to reignite and the Fed's going to have to hike rates again. That is the big sea change, even as we get data that raises questions about just how quickly we'll reach that 2% target.
You've nailed it, as always. What will constrain their ability to respond to a negative shock? Inflation, without a doubt. Why are we comfortable that the stronger than expected data so far this year won't deliver higher inflation in the year to come? Earl Davis, BMO, if you missed it, go back over that interview. It was about 10 minutes ago. He talked about the second half of this year, those inflation concerns reigniting. That would change the game. That would change the game, but I'm not sure that's the base case for a lot of people right now.
It's absolutely not. You know why? Because everyone believes in transitory again. Everyone believes that a lot of these are year-over-year supply chain normalizations that stem from the pandemic. It has to do with workers coming back into the force, people pointing to immigration actually helping to bring down some of the wage pressures because people are able to come and fill the roles. Honestly, all of these things, yes. The key question is wage gains and wage increases still well above pre-pandemic levels. And so that really is one thing that I'm watching.
You can sense this is weighing on Fed officials. Tom Barkin, Richmond Fed, was just sat here yesterday for about 30 minutes. This line, no one wants inflation to re-emerge. The experience of 40 years ago, it still weighs on them. Now, I'm not saying they're like Volcker. They're really not. This is a very, very different FOMC. But I think they don't want history to repeat. They've got the time to wait. At least they think they have. They're going to wait.
And it's wise. I mean, honestly, if you take a look at consumer sentiment, there have been study after study showing that people tend to feel much worse about paying higher rates in the grocery store, even if they're getting higher wages. It doesn't register if you see that your bagel, egg, and cheese costs $8 rather than $4. It makes a big difference for someone's sentiment when they go to work in the morning.
Is this a politics-free hour? Are we going to do that? It can be if you want to. No, it's not my call. It can be if you want to.
You know, here's the thing. Do people feel that it is important to even pay attention to? And the question of, you know, sort of the different race, the horse race between Biden and the situation with some of the concerns over his age and mental acuity, and then Trump and some of his issues with respect to the court system. All of these things, we really want to get into this. We can ask our next guest how much he cares about this.
He can't wait. He does not want to talk about this at all. Coming up this hour, here's the lineup for you. JP Morgan's Thomas Kennedy around the table on why investors should rotate out of cash and not on what's happening politically down in Washington, D.C. Retired Air Force Lieutenant General David Depchler on Biden's increasing pressure on Israel. And Dana Peterson of the Conference Board on the data-dependent Fed, consumer confidence, CEO confidence. Lisa, it's starting to pick up. It's starting to pick up. Now, if you're going to get layoffs, big layoffs in America, you need to get to this situation for corporate America, across the board, small, medium, large businesses as well. They've got to sit there and worry about margins. They've got to sit there, worry about margins and start protecting margins by cutting costs and laying people off aggressively. How close are we to that moment if consumer confidence is building and CEO confidence is building too?
And if you get productivity picking up, so people are maybe more productive and you can increase margins without having to really shift some of the workforce. Honestly, this is the mystery. This is what people are saying because we just saw Pepsi. Revenue expected to come in light. Profits coming in more. How? I mean, well, you got to think, OK, there's got to be something going on with cost cutting. And we see that after company after company. But, you know, at what point does it really make the headline numbers?
Stocks more broadly at the headline level, positive here by 0.16% on the S&P. Our top story this hour, awaiting US CPI revisions. JP Morgan's Thomas Kennedy expecting the results to have limited impact on the Fed, saying this: Fed rate cuts in March are unlikely. Investors should consider rotating out of cash. Too many investors are using the delayed cutting cycle as a reason to stay in cash. We disagree. Our base case is still a soft landing with the first Fed rate cut coming in June 2024. Tom's with us now. Morning, Tom.
Good morning.
Let's build on that. Where should they be going? Out of cash to where?
I think the easiest step is just to lock in a 5% yield in a short duration bond. Now, my clients have the goal of compounding wealth over the long horizon. So 5% is so attractive in the front end, let's lock it in for a longer period of time.
Where do stocks fit in?
Oh, stocks have to be the bigger piece of the puzzle here. You two just did, like, for my clients, the most important transition that's happened in the last 3 months, where the Fed's balance within their mandate has shifted dramatically. And the Fed put, as you might say, was out of the money for 2 years, aggressively out of the money, and the Fed just put it back in the money. So even the slightest hint of layoffs, the Fed can cut, and they can cut aggressively. This should give really credible support to earnings. And now the market's trying to decide, when can I really step to those low quality stocks? When can I get aggressive and get excited? In the meantime, stay high quality, and the market is out. That divergence, high quality stocks to low quality stocks, is historic at this point.
You said, stop making this an excuse to not put your cash to work, that maybe the Fed might not cut rates in March. Is anyone using that as an excuse? Because it doesn't seem like it. We make record high after record high.
Yeah, well, within my community at JP Morgan Wealth, one of the biggest pools of global wealth in the world, you still have over 25% of our investable assets in cash and cash equivalents, think like T-bills. Now, that's down quite a bit, but still elevated to prior experience pre-COVID. So I do think there is wood to chop there. And I think we should all acknowledge the cash trade was a great trade. For 2 years, it was a great trade, the right place to be. But now going forward, it's unlikely to be there because of the Fed pivot, because of this disinflationary process. And then what we see in the labor market. You're seeing robust job growth, but you're still getting good indicators that the rebalancing is happening. It's mostly from the supply side. And the thing people aren't talking about enough, real wages are inflecting higher, but they're still well below trend we saw pre-COVID. That creates room for job growth, but not resurgence in inflation.
There's been a big pivot by the Federal Reserve, and yet we hear person after person, including BMO's Earl Davis, talking about the potential for a reignited inflation risk later this year. How does that sort of weigh on your call here? Maybe not as much even on stocks as it is on the duration call.
Yeah, I think we have to respect the January report, right? This was a solid job print. However, Januaries have been head fakes for the last 4 years. So the seasonal adjustments is a struggle. The broader mosaic of the labor market is one where you're getting rebalancing mostly from the supply side. Are we challenging that right now with January? Sure. But quit rates are below where they were. Real wages are below trend. And when you look inside the inflation data, the demand-led inflation maybe from core services is still too high, but not substantially high, and it is coming down. I think with good balance, the Fed has all the evidence they would need to either cut or stay put. I don't see any evidence right now that they should be considering hiking, and I think that's why bond yields have come down. We've cut off that tail that we need to price a probability that they could cut again.
As you know, there's always something to worry about. And we're at that phase of the cycle, we've talked about this, where we're talking about banks we've never talked about before. NYCB is one of those banks.
Yep.
It's lost a third of its market cap again this week. It's been absolutely hammered since the end of January, when they had to increase provisions because of souring commercial real estate loans. How well do you think this market is doing at discriminating between the banks that will have a problem, small, medium, whatever size, and the system that probably won't?
I think that the market is differentiating these banks incredibly well. A simple cut is to take banks with CRE exposure in excess of capital and say, wow, those are at-risk banks versus ones that have CRE loan exposure less than equity. You're talking about a 40% total return dispersion between those two cohorts since March of last year. Now, New York Community Bank flew under the radar for a period of time, given its small nature of its size. I think it's differentiating quite well. At this point, as we look forward, this risk is here, and it's going to be here until rate cuts happen or everybody comes back to the office. And a recent survey from LinkedIn, from one of my ex-colleagues, Karen Kimbrough, 25% of all jobs in America last year were work from home. All jobs added, 25%.
Yeah.
It marries to what we see in our subway data in New York City. We're here. This is a perpetual risk. So until rate cuts happen, this is a risk, but the market's differentiating.
Yeah, Jamie's trying to get everyone back to work. I'm not sure how that's working out for everybody else. This could be a permanent feature that we've got to adjust to. So let's think about it in the following terms. And we've been asking this question. Do you see it as a single name problem, a sector problem that eventually becomes a broader market problem because it's an economic issue?
Yeah.
That ultimately they have to tighten lending standards and you're going to see their ability to finance the economy. It's going to get diminished in the year to come. How do you frame that?
I think we frame it as a natural credit cycle that many investors on Wall Street haven't seen for 40 years, where the Fed has hiked rates, we have all locked in interest rates, and we're going to have to deal with that higher interest rate environment. Cohorts of the economy are not going to be able to survive. You guys mentioned high yield spreads are really tight. Yeah, but as high yield spreads have tightened, CCC rated spreads have actually widened. It's quite an anomalous environment. What is the high yield investing community saying? Yeah, we feel good about this cohort, but that cohort's going to have an issue. And when we look in our own private credit direct lending data, we see similar types of dispersion. So I just think we're going to go through a credit cycle, and that's maybe helps explain
How
that.
unusual is that, though, historically, to go through a credit cycle, come out the wrong end of it, and see credit spreads at 320 and equities at all-time highs?
It's quite common to be walking into a credit stress scenario and see spreads very tight.
To walk into it, yes.
Yeah.
I'm talking about coming through it out the other side.
Well, we don't know exactly what that's going to look like here, John. I mean, when you look back in history, you do get credit. You can get credit cycles and still see an economy perform very well. It's just you have had a decade of low interest rates where people have been able to survive, or businesses, and maybe that's going to be a reckoning. So I think, how do I frame this?
Yeah.
I can be invested in the stock market, favor cash flowing, high quality businesses, and still find distressed opportunities, whether it be in real estate or in smaller businesses.
I just know the Lisa worry. I could see the Lisa worry playing out.
Oh, yeah?
Have we really played the price to go from 0 to 550? And was the price for that really just a bad year for tech stocks in 2022?
No, I agree with what you're saying, and I'm trying to draw that out. There are these businesses that are going to have...
Carry on, but I am thinking it. Go on.
I'm reading your facial expression here, too.
Well, there are other things going on, too.
I think that we have not felt all of that worry and all of the consequence yet, John. But the point is that rates are at 550, and now they've come down to a place where refinancing activity can happen. And think about that in a single B-rated credit type of idea.
What I'm struck by is that people have walked through all the worries so much that they think that they understand them. And that to some degree, maybe they have. There is a differentiation.
Yeah.
So that's really the key. Have people really internalized the worry, chewed over it, spent hours up at night, figured out how they want to price it, and then it's fairly priced in markets right now so people can discount it. That seems to be where people are at, and I find that pretty interesting.
Tom, final word?
I think from a final word perspective, we have to acknowledge that this cycle has been wildly different. The Fed has pivoted, and now they are a support network for growth and earnings going forward. And for my clients, I want them to take some of that cash that they have sat on and loved and get invested in a world where they can compound their wealth for a long period of time.
Into some higher fee funds and stuff like that. Thomas
That was
Kennedy.
not something I would say.
Just something I said.
Right here.
Tom,
You might say
Tom
somewhere
Kennedy,
else.
JP Morgan. Tom, it's good to see you. Appreciate it, as always, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Russian President Vladimir Putin says he has not yet achieved his objectives in Ukraine. Putin told former Fox News host Tucker Carlson that he would be open to negotiations if the U.S. were to stop sending weapons to Ukraine. The Russian president also discussed jailed U.S. journalist Evan Gershkovich of the Wall Street Journal, saying he believes an agreement could be reached to secure his release. The Supreme Court appears ready to keep Donald Trump on this year's presidential ballot. Justices cast doubt over a suit to disqualify him over his role in the January 6th insurrection. Both liberal and conservative justices question whether the Colorado State Supreme Court had power to exclude Trump on the grounds of the 14th Amendment. The court is set to reach a ruling on an expedited basis, meaning it could come in the next several weeks. The European Central Bank is warning lenders that they may face higher capital requirements to cover commercial real estate risks. The watchdog is now placing greater emphasis on CRE risk, though individual requirements may only apply next year. Commercial real estate fears have bubbled up once again, this time in Europe, Japan, and most notably, New York Community Bank. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Equities right now positive by 0.15% on the S&P. Up next on the program, President Biden lashing out.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine.
That conversation continues up next. Live from New York, this is Bloomberg. Later this hour, shortly after 8:30, sometime after 8:30 Eastern Time, we should get revisions on CPI. Going into that, the scores look like this on the S&P, positive by 0.15% on the S&P 500, yields higher by a single basis point on a 10-year, 416.96. Under surveillance this morning, President Biden lashing out.
How bad is your memory, and can you continue as president?
My memory is so bad I let you speak. My memory is not good. My memory is fine. The president of Mexico, Sisi, did not want to open up the gate to allow humanitarian material to get in.
Here's the latest this morning. The president facing renewed questions over his memory lapses after a damning special counsel report and a new gaffe over the name of the Egyptian president. This as he's set to meet with German Chancellor Scholz this afternoon, with aid to Ukraine and Israel hanging in the balance. Retired Air Force Lieutenant General David Depchler, a current member of the advisory board at Academy Securities, joins us now for more. Lieutenant General, sir, wonderful to catch up with you because we've got a lot to talk about, and it's not about the president's memory. It's about real hard policy and the prospect of conflict in the Middle East that engages US forces even more than they already are engaged. Lieutenant General, can you prevent a war simply by saying you don't want one?
Well, the short answer is no. You can't prevent war by saying you don't want to. The fact of the matter is that if you really want to deter conflict or malign actions that we see unfolding in the Middle East today, U.S. actions need to instill in the minds of both the Iranian proxies and the Iranian leadership itself sufficient uncertainty of achieving their actions so that they don't continue their attacks because they're concerned with the potential consequences. That's what deterrence is all about. So until Iran and its proxies understand that it's their critical interests at stake, attacks on U.S. forces in international shipping in the region won't stop. And in order to do that, I would suggest to you that a course correction is required in current U.S. strategy. And I'm happy to give you some thoughts on that if you'd like.
I would love that. Lieutenant General, what do you think we could be doing that we're choosing not to do?
Well, first, as you alluded to in your opening remarks, the administration has got to stop telling our enemies what the U.S. is not going to do, as that gives them insight into how to continue their attacks. Like you said, the way to deter a wider conflict is not by saying that you don't want a war or that we won't strike inside Iran, but by making sure that Iran understands that if they and their proxies continue attacks on U.S. personnel and international shipping, then they can expect disastrous consequences. And then the U.S. needs to be ready to follow up to create those consequences. Second, we need to shift our weight of effort from shooting down the arrows, if you will, to shooting the archers. And that means not just the launchers and the radars that the Houthis are using, but the Houthi military leadership, command and control, and other critical Houthi military infrastructure. And finally, direct actions against Iran will be fundamental to halt continued aggression by their clients. Now, look, that action can take many forms. It doesn't have to be lethal. It can be non-lethal. It can be economic, or a combination of all of those. But it's important to remember that the center of gravity of the malign activity in the Middle East today is Iran.
Lieutenant General, given the policies that you have seen in place, how long do you think that the current conflict will go on, particularly in the Red Sea?
Well, that's a great question. Unless the United States and its allies change their strategy, as I just mentioned, it could go on for a very long time. It's always difficult to forecast, because generally the only thing one can be 100% certain about is that your forecast will be wrong. But when I say a long period of time, for many months, if not years.
Well, this is relevant to a lot of businesses in particular. We've seen this in a lot of the reports. I mean, mayors coming out saying that it could go on for a longer period of time, but expecting some sort of resolution later in the year. Do you expect that some sort of peace, I don't want to say peace, but some sort of resolution to the war in Gaza right now would bring about some resolution in the Red Sea? Or do you think that people are too neatly drawing that line?
Again, very interesting line of thought. The short answer to your question is there might be some temporary pause. I doubt it, because back to what I said earlier, Iran's ultimate objective is to get the United States out of the Middle East. So they're taking advantage of the opportunities from their perspective to continue pressure on the United States. And just because there'd be a resolution of some sort or cessation of hostilities in Gaza doesn't mean that Iran would stop its malign activity in continuing to encourage its countries like Yemen, the Houthis from continuing their attacks to accomplish their ultimate objectives.
Can we finish on Iran, sir? Lieutenant General, Iran has changed over the last 4 years in the minds of a lot of people. Their capabilities have developed. What is your read on that? How different is this Iran to the Iran of 4 years ago?
Great question, John. It's a much more capable Iran. The Department of Defense just came out with a report yesterday from the Defense Intelligence Agency listing all of the different types of missiles as well as drones that Iran is now exporting. They're not exporting it just to their client states or proxies like Hamas, Hezbollah, and the Houthis, but also they're now a principal provider of this kind of capability to the Russians. That was not the case just a couple years ago. So their technological capabilities are advancing, and more worrisome is the production of those systems, which have been devastating in the hands of the Russians against Ukraine. And you're well aware of how the Houthis are using them to inhibit shipping in the Red Sea.
This has been a concerning conversation, although a refreshing one, sir, away from the politics of the last 24 hours. We appreciate your input. Retired Lieutenant General David Deptula there of the brilliant Academy of Securities, of which Peter Cheer is a big part of course, leaning on the expertise of people like David. Let's just talk about that. It's changed in the last 4 years. There's a lot of talk about how the former president would engage in this situation differently. You've got to factor in the different capabilities of the Iran we're talking about today.
especially given some of the refinery abilities that they have, uranium enrichment that they've really touted has accelerated during this whole process. So how do you deal with a nation that seems to be emboldened?
Interesting 30 minutes still ahead. This is what we're going to do. Dana Peterson of the Conference Board on the data-dependent Federal Reserve as we wait for some CPI revisions going into next week's CPI report from New York. This is Bloomberg. Annmarie choosing to skip the coverage of the political drama of the last 24 hours. She's starting her weekend alongside Lisa Abramowicz. I'm Jonathan Ferro. Going into the opening bell about 60 minutes away. Your equity market looks like this on the S&P 500. Positive by 0.15%. The Nasdaq up by, let's call it 0.25%. In the bond market, main event, stage is set for CPI revisions. Big focus on that. Mike McKee around the table with us ahead of it all. Yields are higher by a single basis point to 416. Let's call it 417 on a 2-year up 2 or 3 basis points. Very close to 450 at 448.20. So, Mike, walk us through it. It's not going to drop all at once any second now, is it? How's this going to work?
I think Annmarie stayed home because this might be like too boring. The CPI every year is seasonally adjusted, of course, and once a year the BLS changes the seasonal adjustments. Last year, when they changed the seasonal adjustments, it changed the CPI significantly and raised inflation in the latter half of the year, which caught Fed Governor Chris Waller's attention. He made a speech about it, and so now everybody is focused on this year's changes. But we're not going to get an official release, which is why I'm not giving you the numbers right now. We get a spreadsheet from the BLS. We plug that into our spreadsheets, and then we'll have the numbers for you. So hopefully we will have them very soon.
Mike, I have to say, there is always a conspiracy theory element saying, well, the numbers are just manufactured, and that's the reason why the revisions are so important and so different. Can you put some clarity on why there's been such difficulty understanding some of the seasonalities and the sort of historical reference points at a time when the data has been revised in pretty meaningful ways again and again?
Well, the problem with the seasonal adjustments is we've had some very weird seasons. When we went through 2020 and the entire economy shut down and then reopened again, and it wasn't based on anything on the calendar, it made it very hard for the BLS and the BEA to go back and make these seasonal adjustments that are based on 5 years worth of previous data. So they've been struggling ever since to come up with accurate numbers. Now, the key thing, well, there's two key things. One, the Fed has to deal with the numbers it has, whether or not they're accurate. And two, the numbers that come in are going to be adjusted in the future as well. So they have to, at this point, just kind of say, well, what are we going to do here? The other important point is that the Fed obviously looks at PCE. And there are inputs from the CPI and PPI into the PCE numbers, but those are the non-seasonally adjusted inputs. So this won't make a real difference to the Fed.
Meanwhile, next Tuesday, we do get CPI for January, and a lot of people saying this is really going to be the main data point that could move markets. So what are sort of the whispers that you hear? Are there whisper numbers? I know not for CPI as much as jobs, but whether to upside surprise or a downside surprise is more likely to trigger some angst.
Well, we're getting a lot of analyst calls that basically say before you read this, just realize we might have to change it after the adjustments. But what they're saying is we should see a reasonably large drop in the CPI, especially on a year-over-year basis, not only because energy's gone down, but because some base effects are falling out. Big increase last January in the CPI, and that'll fall out of the data this time.
Can we go back to Wednesday last week and talk about the news conference, then talk about the Fed speak that's taken place subsequently? There was a takeaway from some people after Chairman Powell spoke in that news conference that he was struggling to reflect the consensus on the committee, that maybe that consensus was breaking down a little bit. I have to say, based on the Fed speak we've heard this week, it feels like they're all on the same page. Have you noticed any subtle differences between Fed officials at all, Mike?
Nothing that would cause you to think there's any division at all. They basically all said we're not going to probably be ready. We've got the data here. So let me give you this first headline that is out, and that is that the revised fourth quarter CPI is unchanged at a 3.3% annualized increase. Now, a lot of people thought that was going to be the case, that the revisions last year would be a one-off. And so that appears to have been the case. The CPI in December was revised down from 0.3% to 0.2% gain. So it just is a slight difference at this point.
Mike, I'll work through the price action as you work through that report, because I know it's a little bit clunky to get through. Let's go to equities first. Session highs on the S&P up by 0.4%. If you turn to the bond market, yields were up, now they're lower. We're down 2 basis points on a 2-year 4.43, on a 10-year down 2 basis points to about 4.13. We had a little look at 4.17 a little bit earlier on today. The euro, a bit stronger now, dollar a touch weaker, 107.83. Just a view here, Lisa, that this takes some pressure off the Fed, just on the margin.
Well, basically on the margins, that you can take the numbers as they are, that there's not some sort of fear lurking under the hood, that these are really more disinflationary than they seem. And you are seeing a response in turn. My curiosity is how many different reads like this lead to some conviction that we're heading in the right direction, given some of the concerns about later in the year and more difficult comps.
And Mike, do you think the chairman can have a little bit more confidence after these numbers?
I think as I explained, they use PCE, so I don't think this is going to make a big difference to him. But it removes sort of something that was hanging out there over the markets more than the Fed, in the sense that the markets were kind of focused on this. As I said, the Fed uses PCE, so they'll be less concerned about it. But at this point, it seems to be kind of a nothing burger. We're not... which is what a lot of people expect.
What do you think of nothing burger, by the way?
I'm going to tell you now that no news on this front is good news.
Yes.
Yeah.
The worry is that revisions would go in a different direction, and that ultimately unchanged is a new beat when it comes to stuff like this, Mike.
It's a dog that didn't bark in this case. We were watching it because the one Fed governor was watching it, and it became a thing because there's no other data this week.
He said, my hope is that revisions confirm the progress we've seen, but good policy is based on data and not hope. And now we can base it on data and not hope, because it's confirmed basically what we've seen. So fourth quarter core CPI unchanged at 3.3% annualized increase. No big changes here, and that in itself is good news, I guess. Equities on the S&P 500 looks like this. Equity futures up by 0.4%. Yields in the bond market a little bit lower, down to 4.43 on a 10-year, down to 4.13 in the FX market. As I say, the dollar just a touch weaker against the euro, 107.86. That currency pair turning around in the last 10 minutes or so. This sets the stage for today and into next week as well. Logan is going to speak later on this afternoon. Lots of Fed speak today and into next week. Bauman, Bark and Kashkari speaking on Monday. Then you'll get data next week as well. US CPI on Tuesday, PPI next Friday. Bloomberg survey expecting core CPI year over year to tick down to 3.7% from 3.9. Data Peterson of the Conference Board seeing risk to those numbers. Evidence of sustained disinflation is needed for comfort that a return to target and staying there is possible. Risks of a pickup in inflation are present, especially from a tight labour market and elevated wages. Dana, I'm pleased to say, joins us now for more. Can we go straight to those revisions, or lack thereof? Your response to them in the last couple of minutes.
Sure, I agree. It certainly is a nothing burger, and that is good news. But again, as Mike McKee mentioned, the Fed is focused on PCE inflation, and it's good to know that we don't have lingering concerns about whether the CPI is breaking away from what we've seen in the PCE. And certainly when we look at the PCE deflator, it's slowing. It's above 2% target, but it's headed in the right direction.
As you know, the Federal Reserve wants more confidence. They want more data, not better data, just maybe more of the same. Now, Dana, I wonder from your perspective, the risk of stabilising above target on inflation, is that a concern that you share?
Sorry, I lost audio.
Can you hear us now, or have we still got a problem? I think we've lost audio there with Dana Peterson of the Conference Board. If we can re-establish that, we'll come back to her. Mike, we can go back to those concerns. On Wednesday, you heard it in the news conference. The chairman just not quite comfortable yet to say that he's got complete confidence that this is going to be the trend through the rest of this year. What are the one-off factors that we've seen that have led to this disinflationary trend that has emerged over the last 12 months? What are they exactly?
Well, the things that they're worried about, they still don't understand why house prices or the home price index part of all of this is not going down faster than it has. They're watching used cars because they've been very volatile. Airfares, hotel rent, hotel costs, those are the things that have been bouncing around a lot. So they're waiting for them to sort of steady out, and we get, I think the term that was used was a broad drop in the inflation data. One of the things that they can't control, obviously, is energy, and they have to worry about what's going to happen with the Middle East, but they'll look beyond that. They're looking for these other internal things to continue going down enough that they feel that it's not going to be something that will turn the whole thing over.
There is concern about the Atlanta Fed wage tracker. It's something that I've seen in a host of notes coming out. Yes, it's come down dramatically, but it still is well above what you would expect to get back to 2%. What do they need to see there, given that it's running at about 5% or north of 5% still above pre-pandemic norms?
Well, that's one indicator on wages. And in general, we're seeing wages rise at a faster pace than the Fed is looking for. We saw wages in the ECI going up at about 0.5%. And that is a concern if it continues. They want to see it come down. They think 3.5%. 3 to 3.5% is consistent with stable inflation. So we've still got a ways to go with wages, but they don't seem to think at this point that the Fed has got a problem because CEOs are telling them they're slowing the rate of pay increases now.
Dana Peterson, I believe we've reestablished our audio. We apologize for any technical difficulties. Dana, your take on just what you're looking for to understand whether the inflation genie's truly been slayed or the inflation dragon. I assume people don't want to slay genies, but how much are you seeing this actually as a done deal versus still concerned about a couple areas?
I think much of the Fed speak in terms of wanting to see sustained disinflation in order to get back to the 2% target sustainably is important. When we look at some of the details of inflation, yes, home prices have eased, and that's showing up in rents and the shelter costs. But when you look further out, they've picked up. And so that poses some risk later this year and even into next year. But more importantly, wages are still elevated. We're seeing them rise, especially in those sectors like manufacturing, construction, where there's a lot of demand and you have to show up for work. So I think wages will continue to be an upward pressure that the Fed's going to have to watch. So it's important to have more readings and maybe getting into the springtime to feel confident such that the Fed can start cutting rates maybe around June.
Can you give us a sense, based on the increasing confidence that you track, given the fact among consumers, given the fact that you are concerned about some of these areas that are still elevated in terms of inflation, how many times you think the Fed could cut rates this year versus where the market's at?
Sure, we think the Fed could probably cut rates 4 or 5 times this year. That's roughly 125 basis points. And that would be reasonable, especially given the fact that the economy is doing better than expected. We still think there could be somewhat of a lull, maybe not a recession, but inflation should probably continue to slow. But again, we have a number of risks out there, both to the upside and the downside. But I think that certainly 125 basis points this year is possible.
Is that based on the idea that the neutral is back to 2% or something like that, the neutral rate? I mean, what is that based on if you do see these risks to the upside for inflation still present in the market?
Well, I think that, the neutral rate is probably higher now than it was before the pandemic. Here's why. We've had a major structural change in terms of the labor market. We're losing workers. We're experiencing severe labor shortages, and that's putting upward pressure on wages. We also have a number of outside factors, such as deglobalization and also the fact that you have a number of geopolitical risks that are disrupting supply chains that can continue to put some upward pressure on inflation. But those are all in the risk category. Our base case is still that we're going to see inflation get back to 2% and remain there, but that the Fed's going to have to keep rates higher than expected and not see as much in terms of cutting as the market probably is pricing in right now.
Dana, I'd love your views on the pickup in consumer confidence we've seen more recently. Likewise for CEO confidence as well. How do you read that at the moment? Do you read that as temporary? Could that be the trend? And ultimately, what does that mean for the forward look, the outlook for the rest of this year?
I think they're both positive trends. With respect to consumer confidence, we've seen a few months of improvements. Consumers are complaining a little less about inflation. They still think prices are high, but they're not rising as quickly. They're looking forward to interest rates being lower, and they think the stock market is going to continue to rise. They also feel that they're going to continue to work. And certainly that's showing up in our CEO confidence measure, where CEOs are still worried about labor and they want to hold on to their workers. So if you're a consumer, you're working, you have a credit card, you can spend, then you're probably going to feel better about life.
Interesting. Dana, thank you. Dana Peterson there of the Conference Board. Following those revisions, or lack thereof, according to the latest data incorporating annual revisions, US inflation about the same at the end of last year as initially reported. No news is good news on this front. Let's put it that way. Here's the price action. We'll start with equities, work our way through bonds as well. Equity futures on the S&P still just about positive, fading from session highs. We're up here by, let's call it 1/3% on the S&P. Yields were higher going into these numbers. They're lower now, not as low as they were about 10 minutes ago, but lower. We're down by almost a basis point on a 10-year to 4.15. On a 2-year, let's call it 4.45. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Treasury Secretary Janet Yellen says regulators are watching for risks from non-bank mortgage lenders. Speaking at the Capitol, Yellen cautioned that non-bank lenders risk failing due to their lack of access to the same deposits as traditional banks. Non-banks have become a major presence in the mortgage market. Regulators have continued to warn oversight hasn't kept pace with their increasing footprint across finance. Shares of ARM hit an all-time high, surging 48% on Thursday after the chip designer posted a blockbuster earnings report bolstered by AI. Speaking to Bloomberg, CEO Renee Haas says their AI is in early stages and is not, quote, in any way, shape, or form a hype cycle. ARM's bullish outlook helped send shares to the biggest single-day rally since its IPO in September. Expedia shares continue to fall in the pre-market trade after lower guidance, a miss in travel bookings, and a surprise change at the CEO level. Ariane Gorin will take over from Peter Kern as chief executive. The company also plans to spend a record amount on marketing in order to compete with Airbnb and Booking.com. And that is your Bloomberg Brief. John.
Danny, thank you. Thank you very much. Up next on the program, Super Bowl ads flirting with record highs.
It's great that the San Francisco 49ers are in the same sentence with Taylor Swift. Like, these are good things for our brand, and we're going to lean into them as much as humanly possible.
That conversation up next. Live from New York City, no big changes after those CPI revisions, which means equities are okay, positive by 1/3%. It means bonds are a little firmer than they were earlier. Yields unchanged, 4.1521 on a 10-year. Dollar just a touch weaker. Euro just about unchanged, 107.81. Under surveillance this morning, Super Bowl ads flirting with record highs.
The NFL, as a culmination, we all benefit from, frankly, Taylor or the next storyline, because it increases our media value, it increases the general fan, as you mentioned, that might follow the game. And the reality is, we benefit because those people are tuning in. If they're a casual fan, they're tuning in around the storyline. It's great that the San Francisco 49ers are in the same sentence with Taylor Swift. Like, these are good things for our brand, and we're going to lean into them as much as humanly possible.
Good things for their brand as well. It's the wrong team. We're talking about the 49ers. We're not even talking about the Chiefs.
Wasn't it someone's mother on the 49ers was like, you know, Taylor Swift is dead to us for this particular week, and then she can come back into our lives? You know, there's sort of mixed feelings.
Everyone seems to be winning from this. Everyone seems to be winning. Here's the latest today going into the weekend. Big brands looking to spend big ad dollars on pop culture buzz for the second consecutive year. The average cost of a 30-second ad spot during the Super Bowl hitting $7 million. Michael Hartnett of Bank of America Global Research wrote this today. I think this is great. A 30-second ad during Super Bowl I was $37,000. And the price for Super Bowl 57 was $7 million, a 185 times jump. Nothing keeps pace with Super Bowl inflation, but if they could, a six-pack of beer would be $340, a gallon of gasoline $61, the average US house price $4.2 million, the S&P 500 $16,374. Bramo, it's not bad.
You know what keeps up with inflation for
Go on.
Super Bowl ad? Taylor Swift. Basically anything she touches, as well as Lionel Messi. I mean, basically they can have that same kind of inflation draw. Here's the thing. It's the consolidation of eyeballs. How many eyeballs and paying for the privilege of offering something up to those eyeballs.
It's the sport, the ads, the halftime show, and now it's the people in the audience, the crowd as well.
Isn't it
crazy.
Bet, like whether or not
nuts.
they're going to show her and what that's going to do?
Of course they're going to show her. Come on. Of course they are. Barton Crockett joins us now of Rosenblatt Securities. Barton, let's talk about this. What are we tuning in for, and how big is this audience going to be on Sunday?
Well, I mean, last year when the Chiefs played the Eagles, I think the numbers came in at about 113 million viewers. This year, the price $7 million flat with last year. You think we could grow it, right? I mean, you've got the Chiefs back, you've got the Taylor Swift thing, the 40 in the San Francisco media market. These guys, 7 million's a lot, but they may be getting a bargain if the audience goes up, which has been the trend all season with the NFL. That's been really defying all the other pressures on TV. More people tuning in for football this year.
It's just amazing, Barton. You take like the top 10, top 20 sporting events, top 10, top 20 TV events of the last 12 months, and the NFL just dominates the list. But when you look at football versus everything else, how is everything else in sports performing?
Nothing's performing like the NFL. I think that Major League Baseball had a decent year last year. The NBA has been kind of up and down, but generally healthy. But the NFL had really decent growth in audience across the regular season into the playoffs. High single, double digit type of audience growth. Even as the number of people subscribing to pay TV is pacing down 8% year over year, and it's been doing that for a couple of years running now. Only half of Americans have a pay TV subscription, but 113 million of us last year tuned in for the Super Bowl, and probably more this year.
How much is it because eyeballs beget eyeballs? The idea that so many of the ads are going to feature celebrities, and the fact that more celebrities are watching the game means that other people watch the celebrities watching the game. I mean, how much is it becoming this sort of, consolidation of eyeballs that you can then bank on to bring in bigger names that can then do even better?
Well, I think certainly this kind of pop culture kind of fandom that's really fueled by social media is it. I mean, that's really something that's very different than when you put up that previous quote about what a Super Bowl ad cost a generation or two ago. We didn't have the type of Instagram, the type of TikTok, the type of social media engagement of someone like a Travis Kelce that we have today. And that's, I think, a big part of why their audiences are bucking these trends on pay TV.
This conversation is kind of making my soul die a little bit. I'm just listening to this, and I'm wondering what this means in terms of going forward, in terms of the consolidation of ad revenue and where it's going to happen. How much is this the anomaly when it comes to cable television, where you can actually get these kinds of ad revenues, and how much are they shifting just directly to the Instagram and the TikTok and these other platforms where the celebrities live?
Look, the ad trends are clear. I mean, the Super Bowl, ad price at 7 million, a sellout, maybe isn't growing even if the audience is, and this may be, maybe a sign of a peak. I guess, time will tell, but certainly television advertising has been pressured. And what we're seeing is that as money is pulling out of TV and going into internet streaming, it's going into e-commerce driven and social media driven ads on things like Meta and Amazon. And what I think you're going to see is generationally, you're going to look back and these big sporting events will move from television to the internet and probably the tech giants. Amazon has Thursday Night Football.
Yeah.
Apple's got Major League Soccer. In 20 years, one of those guys will probably have the Super Bowl.
We wanted to talk about that, Barton. We wanted to talk about this new joint venture, if we can call it that, the Walt Disney Company, Warner Brothers Discovery, Fox as well, pooling things for sport. How do you see that? Is that a distribution exercise, or is that about being more competitive when it comes to getting those sports rights?
Look, I think it's more incremental than revolutionary. I mean, this basically a skinny pay TV bundle that'll be sports focused. The TV conglomerates are going to have to charge a fair amount for that. It'll probably cost $40 or so a month. So not terrifically cheaper than the $73 a month you could pay right now for YouTube TV, and also get all the news channels and also get all the entertainment. You'll have like a selection of 14 channels that have a lot of sports and a few other things on the skinnier bundle. But I think this speaks to, desperate times require desperate measures. These media companies would not have allowed, other distributors to just cherry pick their prime sports-driven channels. They would have, they've forced onto the distributors their other channels. Like you had to get Fox News if you're going to get Fox broadcast. You had to get you had to get the FX channel if you were going to get ESPN and ABC with their sports coverage. So they're breaking that kind of forced bundle for themselves. I think for Disney, it's decently sensible in that they're bundling a lot of different streaming services together, and they're exercising the art of package selling that's uniquely available to them because they have multiple scaled services and the others less so.
Barnum, we got to go. Enjoy the game, sir. It's great to catch up with you. Thank you. From New York City, counting you down to the opening bell, about 34 minutes away. Equities are doing okay.